the market's paying up for quality. And so it's back to stock picking, it's back to factor selection.
We are so dependent on these, large index stock flows. If you start seeing outflows from that, it's going to hit those big, Mag 7.
If we don't have earnings moving up in a meaningful way, it's hard to say we're going to have a big upside to the overall market.
We had high expectations for big market and economy impacts, so we're seeing a slower on-ramp for that.
When you look under the hood, there's rotation happening, and that's what's dampening volatility.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, just about snapping a 4-day losing streak on the S&P 500. Equity futures this morning with a bounce. Here are the scores. On the S&P 500 up by 0.6%. On the Nasdaq 100 up by 0.63. The main event, one stock, a single name. It's Nvidia in the pre-market with the tiniest of bounces. We're up by 0.98%. Jensen Huang says demand for Blackwell is amazing. The Street calls it underwhelming.
Well, amazing isn't insane, so can we really say that it's really that exciting? I mean, this comes down to the nuance of how expensive it is to make some of these chips at a time where there is a lot of competition growing elsewhere. This was all around a great report, right? There were a lot of signs that, yes, it was a beat and a raise once again. Sales guidance was a little above what people expected, but it was the smallest revenue beat in about 2 years. And costs, operating margins coming down, and that, I think, is the focus.
That's the earnings. The next stop is the economic data later on this morning, 8:30 Eastern Time, jobless claims. Why are jobless claims so important? They're becoming more important following the cuts we're about to see down in Washington, D.C.
So there are two things that people are going to be using the jobless claims for. The first is going to be to signal just how steep some of the DOGE cuts have been, how concentrated they are in specific states. Imagine a lot of state-by-state dissection of just what these details show. And then you layer on top of it this idea that we just saw this huge growth scare, really reprice cuts, Fed cuts into the market. Do you get confirmation of that with jobless claims going up or not? Do you get sort of a rebuttal of that with the idea that we're still in this pretty calm place?
With some confusion around the tariff story, Anne-Marie's down in Washington, D.C. this morning. You'll see plenty of her in the nation's capital. These are the proposals. We keep going to the calendar. Let's go to the calendar once again. So on March 4th, next week, 25% tariffs on Canada and Mexico. In the middle of March, we're talking about 25% tariffs on steel and aluminum. Then in early April, the reciprocal tariffs. The EU might be in trouble. Then yesterday, some confusion. Is Canada and Mexico next week or the following month?
So President Trump suggested that maybe it was April 2nd that the Canada and Mexico tariffs would go on versus the March 4th that previously thought. The White House came out and said, no, March 4th is still the time. That I don't know where the confusion is coming into the play, but we still have the deadline. So the market immediately priced in the idea that we were pushing back or maybe never going to get the Canada and Mexico tariffs. And the White House is still throwing out that maybe that's the case. But it just highlights the uncertainty and the lack of conviction and, frankly, just how much this market is not pricing in the likelihood of Canada and Mexico tariffs actually going on.
Speaks to some of the inertia that you're seeing in the business community right now and for consumers alike. Equity futures right now on the S&P positive by 0.6%. Your lineup through the next 60 minutes looks like this. We'll catch up with Chris Verrone of Strategas, a stock snap, a 4-day losing streak. Terry Haines of Pangaea Policy on President Trump's EU tariff threat. And Torsten Slok of Apollo as the DOGE cuts deepen. We begin this hour with stocks higher as markets digest Nvidia earnings and a little bit of confusion on the tariff front. Chris Verrone of Strategas, a Baird company, writing, for all the concerns about tariff policy, the market still seems more worried about growth than inflation. Chris joins us now for more. Chris, good morning.
It's great to be here, John.
Kept going over your quote from the last time we spoke.
Yeah.
Do lower yields speak to some kind of economic weakness, or do they support cyclicality in the equity market? Is the equity market answering that question now?
Well, yeah, I think that's what's been so important about this move lower in yields over the last month or so, is it has not recatalyzed the leadership from the market's more cyclical corners. I think it's a very big change in the character of what we've seen, frankly, over the last 18 months, where when you would get relief in yields, you would, re-entertain this broadening of the market, this cyclical or small cap leadership, and you just have not seen that here to any great extent. So what we ask is, are lower yields actually more reflective of maybe something sinister with the economy moving forward? And listen, I think the jury's still out on that. Financials are still pretty good here. Credit's still relatively calm, but it would be silly not to even entertain that here.
Does credit confirm? Was going to be the next question. What do you see in credit in high yield, in the more speculative parts of fixed income?
It's still remarkably benign here. That's why I don't want to get too my skis or too carried away with the growth scare call or the market's putting in some big top call. Because at the end of the day, if something really sinister is out there, you're going to see it through the lens of where you typically see it. Weaker financials, weaker banks, weaker credit. And we can't check those boxes yet. So we're alert here. We put out a note last week, some reasons for caution. I just don't want to get too over my skis with that view yet until you begin to see changes in financials and credit, which you have not gotten yet.
Is there a larger takeaway here? And John was laughing at me the other day when I said, actually, if you get a good auction, that could be a bad thing too right now. And he's like, it's a bad auction, it's terrible. If it's a good auction, it's terrible. How much more bearish can you get? But is it telling of where valuations are in risk assets that a rally into bonds could be viewed more for the negative? And if you get a sell-off in bonds, that also could be some sort of hit to valuations at these levels.
Well, I'll make a couple points. I think, Lisa, what you described there is simply a game of expectations. And I think we entered 2025 with the expectations game very full domestically and very light elsewhere. And what have we seen to start the year here? We've seen Europe and China, I think, easily exceed low expectations, while we've struggled here domestically to kind of meet the bar of high valuation, maybe deteriorating technicals, and all the like. So that expectations juxtaposition was really, I thought, the crux going into 25, and I think it remains one going forward. When you look at the inflation impetus behind tariffs or immigration, the places where I would expect to see it, higher bond yields, you're just not seeing it. So again, it comes back to the question, maybe the market has more growth concerns on its mind than it does inflation. One last big point here. While we've seen cyclicality weaken domestically, I think it's important that we have not seen that elsewhere. Cyclicality has not been extinguished globally. I mean, cyclicality is alive and well in Europe. It's really alive and well in Asia and China here. So it seems like, if anything, cyclicality has just migrated to other parts of the world. What do Europe and China have in common? They have much more accommodative central bankers right now. I think that's the big difference.
I think you nailed it when you started by saying it's been a game of expectations. And a lot of this is just simply the money moving to places where it seems that evaluations maybe are a little less extreme. Have we already overdone that? I mean, is that basically what we've seen to date? And now any further decline in yields, any further deterioration in equities has to come on true evidence of really true weakness in the U.S. versus just simply a rejiggering of capital flows.
You know, I think we sit here, 10-year yields went out at 425 yesterday. They're maybe 430 this morning. The 2-year average in yields is right about here, about 420. So basically, the last 2 years, you've made no progress. For as much as you want to take credit for yields lower here, the reality is no one's really made any money on either side. It's been a range. So I think at the end of the day, where's the bottom end of that range? Somewhere around 390, 380. I think underneath that, then you'd really begin to say, whoa, wait a second. What is the market really messaging about the economy here? So I think we're okay here. I think we're in some range. The market's digesting these expectations. What we don't want to see is the internals get any worse. We're sitting here with 65% of stocks above the 200-day moving average. Don't want to see that much under 50%. That turns a split market into a bad market.
What you described, though, at the equity level, Europe versus the United States, China versus the United States, is also taking place at the fixed income level, which I find really interesting. We closed out last year, and 10-year government bond yields in America are climbing. In China, they're cratering. They're rolling over aggressively. And if you look at the charts to start the year, it's like we flipped. What explains that story?
Yeah, I think really important change there. And, you know, we've been very much in this camp that what was beginning to play out in China over the last year was very reflective of what 2008, 2009 looked like here domestically, where you were in this financial crisis and you just couldn't get stabilization until particularly the short end of the bond market stabilized. We've now seen that in China. I mean, 2-year yields in China are up 55 basis points over the last 5 or 6 weeks. I think that is essential to really changing the tide and changing the narrative. Remember, you've had these kind of fits and starts of rallies in China over the last year, but this is the first one where bond yields have actually gone up. That, I think, is a really important change. Also, look at the leadership in China. Discretionary is trouncing staples. Financials have broken out. Tech and semis are your leadership. It is a really clean leadership setup in China. I think it's suggestive of the market saying we're past the worst of the economic recession there.
It's a massive sentiment shift backed up by higher bond yields. Stateside, we've got this big dislocation going on in the equity market. The Mag 7 down 10% from all-time highs in December. What do you and the team tell clients to do with that now? What's the approach to tech?
So when you kind of take them one by one, and I'll say this as someone who's not a particularly level-sensitive investor or analyst. I like to think more about the character of a market or what the leadership looks like. But I think this is a year where you do have to be very level-sensitive because this Mag 7 is not monolithic anymore. And you look at Nvidia up modestly after what seemed like good numbers. That always raises an eyebrow to me when you can't respond to good numbers. But the reality is, it's a stock that's been dead money for 7 or 8 months. It really has not made a new high since about June. I mean, there was a fractional new high late last year, but really has not made a new high since June. I think as long as that's under 140, 144, it's probably the same story, kind of dead money here. When you look at Mag 7 or just large cap tech broadly, I think the other big story, though, is it peaked relative to the S&P the exact same day that dollar-yen peaked, July 10th of 2024. So to think these two things are not related, I think, would be silly. I mean, what's been a bigger driver of flow east to west than yen carry over the last decade? So to the degree that's changed, I think it's important.
That's exactly where I wanted to go. And how much is this in tandem with the fact that the dollar's weakened versus strengthened so far? How much do you see a stickiness to that reversal in flows? This idea that countries that used to be huge investors in the U.S. suddenly are seeing more to favor at home?
Yeah, I mean, what's the first rule that you learn in this business is capital goes where capital is treated best. And I think for a long time, when the interest rate was fixed or suppressed, that rule was thrown out the window. That rule's back. And the fact that, I mean, look at Japanese 2-year yields or Japanese 10-year yields, I think they tell you the whole story. We're going to get more from the BOJ. I think the BOJ is going to surprise on the hawkish side. I think dollar yen is telling us that. But not just dollar yen. Look at every yen pair, right? Sterling yen, Aussie yen, Euro yen, you have put a major, major bottom in yen. So again, what does stronger yen mean going forward? I think less money moving east to west. Where does that impact? Well, what's been the biggest receiver of these flows over the last decade? So I don't think these things are entirely coincident. I do think there's some causality here as well.
We've been building up a dollar long for the best part of a decade plus. Dollar-denominated assets, and part of that story has been big tech and a Mag 7.
And that's the reason why the idea that we're talking about the dollar yen and how that coheres with the peak that we saw in Magnificent Seven is really important to me. I keep thinking about the credit pockets that the Japanese investors, CLOs, collateralized loan obligations, that Japanese investors are some of the biggest investors in. What does this do to potential dislocations down the pike? Really interesting.
Hey, Chris, smart as always. You're one of the best. Appreciate it. Chris Verrone there of Strategas, a bad company. Dollar yen this morning, 149.80. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. At his first cabinet meeting, President Donald Trump gave conflicting messages on the future of tariffs. The president said that tariffs on Canada and Mexico would go into effect in April instead of the March deadline. White House officials later clarified that the deadline, though, does remain next week. Trump also proposed 25% tariffs on the EU without further details. A check on shares of Nvidia. They are higher by 1% in the pre-market after initially trading flat. Earnings beat analyst estimates. Gross profit, though, that will be tighter than expected as it rolls out its new Blackwell chip. Those results amid concerns about whether AI capex would slow and the potential impact of U.S. tariffs. Amazon's cloud unit has built its first quantum computing chip, joining the likes of Alphabet and Microsoft in reaching the computing milestone. The hope is that quantum chips will lead to advancements in fields like chemistry and healthcare. Amazon Web Services named the new chip Ocelot, referring to its oscillators. And coming up, 11 a.m. on B-Tech, an interview with Amazon CEO Andy Jassy. And that's your brief, John.
Danny, thank you. Don't miss that. More from Danny in about 30 minutes' time. Up next on the program, tariff uncertainty.
Mr. President, can you clarify the Canada-Mexico tariffs? You had put that 30-day pause, but you just referred to April.
25%.
25%. When does it go into effect?
April 2nd.
April 2nd for Canada-Mexico.
Correct. And for everything.
So is it March or is it April? We'll try and get you some clarity in just a moment with Terry Haines of Pangaea Policy. Live from New York City this morning. Good morning. Equity futures on the S&P 500 up here by 0.6%. Check out the bond market. Yields bouncing back by 5 basis points. We've had quite a run of lower yields. We'll talk more about that later in the program. The 10-year right now, 4.30. 77. Under surveillance this morning, tariff uncertainty.
Mr. President, can you clarify the Canada-Mexico tariffs? You had put that 30-day pause, but you just referred to April.
25%.
25%. When does it go into effect?
April 2nd.
April 2nd for Canada-Mexico.
Correct.
And
for everything. It'll be 25%, generally speaking, and that'll be on cars and all other things. And European Union is a different case than Canada, different kind of case. They've really taken advantage of us in a different way.
So here's the latest this morning. President Trump causing just a little bit of confusion over when tariffs on Canada and Mexico will be enacted. A White House official saying later on Wednesday the deadline for the levies remains March 4th. Annmarie joins us now from Washington to attempt to make some sense of all of this. Annmarie, how do you make sense of it?
Well, Jonathan, it's confusing, right? Because we also heard from the Commerce Secretary Howard Lutnick yesterday at the cabinet meeting, who seemed to insinuate that there is potentially a path forward for another pause with Canada and Mexico if they were to really come in with solutions to stem the flow of migrants and fentanyl. So we're 5 days away. And like the markets, I am also confused. So here to help us out this morning is a friend of ours, of course, Terry Haines of Pangaea Policy. Terry, great to have you. Great to see you in person. Tell us, should the markets be believing Commerce Secretary Howard Lutnick or Donald Trump right now?
The answer is yes, I think.
Yes to which?
Well, I think the decision has been made. I think they employ strategic ambiguity, a phrase familiar to the Taiwanese, but they think that's part of the deal making, and they will continue to do that for a while. And one reason why I think it's premature, frankly, is that you've got a situation where they have said all along that they're going to look at reciprocal tariffs and the like in an April timeframe. So I think this is very much kind of flying by the seat of the pants until then.
So even if we get some sort of tariff level next Tuesday, I mean, this is 5 days away. This is just around the corner. Does that mean then the level could rise to 25% for those two trading partners, which are part of the USMCA,
Sure.
by April 2nd?
Yeah, it could rise or it could fall. One of the things that Secretary of Treasury Bessent has been very specific about is talking about it's a path-dependent decision on a lot of these things. So in this case, the path is dependent on what the other countries actually do in response to what the United States wants.
So choose your own adventure. So
yeah, kind of. Yeah.
So if you're the leader of Mexico or Canada, what kind of concessions are you right now offering this Oval Office?
You want to continue to push on border. You want to continue to show them that you're serious about the border, and you want to continue to show them that you're serious about the flow of illegal drugs, particularly fentanyl, into the country, because that's what the Trump administration says they care about. And you also want to talk to them about autos, frankly, because they will perceive that as a Trump weak spot, but that benefits all countries to be able to figure out how to massage that.
And something already we've heard auto executives like the Ford CEO talking about how this could, quote,
Exactly.
blow a hole in the industry.
Exactly.
Trump was also very direct yesterday about the European Union. 25%, he said, are coming on those sectors. What should the European Union be doing right now?
As aggressively as possible, talking to them about ways to mitigate whatever they think the problem is. I think one thing that the United States does not know, that the European Union does not know, is frankly what the United States' interest is, and whether it's purely economic, whether there's some other issue or others. My suspicion is that Trump is using the European Union tariffs as a way to keep the European Union in line on Ukraine, frankly.
When it comes to Europe, there's also the United Kingdom. Keir Starmer is going to be the prime minister in Washington, D.C. today. Joint press conference with the president at 2 p.m., so hopefully we'll learn a lot. But right now in Congress, Democrats and Republicans are reintroducing a bill that's been floating around before in the past to try to get a trade deal done between Washington and London. Do you think this fight Trump is about to have with Brussels can actually help Keir Starmer get this over the finish line?
Oh, yeah, absolutely. The UK very much wants to differentiate itself from Europe in this regard. This is tough for the Labour Party to do, obviously, because they're much more Europhilic in that sense. But the bottom line is that you have Starmer seeing an opportunity, and you have Starmer also being pressured by the Conservative Party, the party out of power, to do a trade deal with the United States at a time when growth in the UK is almost impossible to come by. So it could be a win-win for Starmer, sure.
And the U.S., I believe, has a trade surplus with the United Kingdom. So already, do you think Keir Starmer is being treated potentially differently than, say, the European Union?
Oh, very much so. And Trump has always treated the UK distinctly from the European Union. When Trump first came to office in 2017, it was just after Brexit, recall, and he has always wanted to pump up the special relationship in a variety of different ways. And I think we're about to see economics take center stage here.
Part of the tariff plan, if you look at the entire Trump 2.0 agenda and all its scope, part of the tariff plan is to offset the tax cuts. And there's a fight going on right now between House Republicans and Senate Republicans on how they're going to enact that agenda. And there's this wonky debate over if they cut taxes from current policy versus current law. And potentially, depending on which way they go, it could mean trillions of dollars on paper, or potentially that it's costing no money. Can you explain this flashpoint right now in the debate? Because I think it's really important, but also which way you think they're going to end up going?
Yeah, I've been banging on about this for a while, and it's starting to go public. It's current policy versus current law. Generally speaking, what happens is that these things get scored in Congress as current law. Now, and current law assumes that the tax cuts are going to expire. Current policy assumes the opposite, assumes that tax cuts are going to continue. So what ends up happening in tax cuts, wonky but very important, is that the tax cuts become much larger and the pay-fors become a lot smaller because of that assumption.
If they cut from current policy, does that mean Trump has this fiscal room to add in more of those tax aims he talked about on the campaign trail?
Yes,
no
absolutely.
Tax on tips, no tax on Social Security, because right now that is missing from the House plan.
Exactly so. My favorite example of this always is salt, because, of course, it always excites people in the...
Or because I'm from New York, you feel the need
excites
to drop
people in the New York area. But, the salt blows a huge hole in things. But it doesn't blow a huge hole in things if you're going from a current policy baseline. So you get that room, yes.
Can Johnson, though, do current policy and get the fiscal hawks on side to vote for that?
I think he eventually will, yeah, because Trump will pressure them into doing it.
Where else can they get offsets?
They're not going to be able, I think, to get the amount of savings in Medicare and Medicaid that they would like. They look at it as efficiencies. That's going to get draped around their necks.
But they said they're not cutting from Medicaid.
Well, they say they're not, but you can cut from the infrastructure of Medicaid, right? I mean, you can assume that there's maybe too much underneath all of it.
But technically, that would be a Medicaid cut.
And which allows the Democrats and others to hang it around Trump's neck, hang it around Republicans' neck. So I think that's going to be a problem. And that's frankly one of the things I think that's driving them towards this current policy baseline.
There's another cloud looming on the horizon, 15 days potentially to a government shutdown.
Yeah.
Do you think they shut down?
I'm about 40% today, which is high, and I think it's rising for two reasons. You've got three parties involved, Democrats, Republicans, and Trump. Two of those parties get advantage.
Is he on the Republican side?
Well, two of those, I tend to look at him as like a free-roaming vapor more than anything else. But two of those get advantage from shutdown. Democrats, of course, want to show people that they're against cutting things, that the spending cuts, and it allows them to be run against Elon Musk. Trump also can be advantaged by saying, look at what these people want to do. They want to stop government efficiencies. They want to stop what we're trying to do, which on its face is pretty popular. So you might stumble into something, yeah.
So basically, you have the opportunity with the shutdown for either side to maybe spin it.
Yeah.
Spin it.
Yeah.
All right.
But
so
do I think it's disastrous? No.
It's going to be a spin potentially in 15 days. Terry Haines of Pangaea Policy, thank you so much for joining us this morning. John, lots of confusion in Washington, D.C. when it comes to tariffs, and we have all these tariff dates in the diary to pay attention to. We almost forgot, 15 days away. We could be in the middle of a government shutdown.
It's going to be a busy couple of months with that to think about as well. I think we can only think about one thing at a time, but at the moment we're thinking about tariffs. And what it's doing to the economic data, just people pausing, hit and pause. How many times have you seen a phrase, wait and see, from an executive over the past few days?
Yeah, we saw it again last night from Sweetgreen. I mean, again, you have to wonder how much people are making excuses for overall changes to consumer appetite. They want burgers, not salads. And how much is this something else? But yeah, we're hearing this more and more.
Big stock to watch in the pre-market. Nvidia is up by 0.9%. We'll catch up with Joseph Moore of Morgan Stanley on Nvidia's good but not great earnings report. Let's check out the equity market. Equity futures on the S&P 500 up by 0.6%, just about snapping a 4-day run of losses in yesterday's session. The S&P 500 almost totally unchanged to the close. Check out the bond market, just a mix of uncertainty around trade and some weaker than expected economic data, taking 10-year yields lower for 6 consecutive sessions. This morning, higher by 5 basis points. The 10-year Bramo, 430.96.
And in some ways, it's been a gift to Scott Bessent, who takes a look at the 10-year yield every day. And right now, he's gotten what he wants. And guess what? The Treasury Department has had auctions that have been incredibly successful with a huge amount of demand. Question is, how high is the bar for this to continue, given the fact that the economy isn't actually crumbling and people might be feeling bad, but they're still spending. So it becomes a sort of difficult equation where it seems like there needs to be a real re-rating of what the Fed's going to do for there to be more.
The next stop for this conversation, 2 hours away. Jobless claims just around the corner. Look out for that economic data at 8:30 Eastern time. So in the bond market, we've had a run of almost 7 consecutive weeks of falling 10-year bond yields, and that's taken some heat out of the US dollar. Let's check out the dollar against the euro. Euro dollar, a sneak peek things for you. 104.79. DXY weaker so far for 4 straight weeks, the longest run since September.
And it really goes to what Chris Verrone is talking about. How much is this just a reversal of what we saw at the end of last year with flows changing? Capital going where it gets treated best, where suddenly rates are rising in places like Japan, even as you mentioned in China. How much has this story already played out, and how much is this going to be fueled by something that happens in Europe, say, if there is an investment in defense, or, say, on the flip side, if there is evidence of a weakening U.S. economy?
Chris Verrone was talking about capital going to where it's treated best. I think there's a difference between capital being pushed away and capital being pulled away. At the moment, I think you can make the argument that capital is being pushed away by the uncertainty around policy in the United States. It can come back once you get some clarity. For it to be pulled away, you want to see better growth in Europe, you want to see better earnings trends, and I'm not sure we can make a really strong case for that just yet.
And I think that's the reason why everybody comes on and they give you a whole laundry list of reasons why you should be uncertain and feel bad about what's going on with U.S. policy and the uncertainty there. Then they say we still prefer U.S. for everything else, and absolutely we will not pull our money out. So it sort of goes to this question of what are people doing versus saying.
Right now, we're selling bonds again. Yields are up by 5 basis points. It's a minor move against the backdrop of a bigger move over the past few weeks. The 10-year at the moment, 430.58. On our radar this morning, President Trump raising more questions than answers on tariffs. Trump saying levies on Mexico and Canada will go into effect on April 2nd, after previously saying March 4th. Trump also proposing 25% tariffs on the EU without further details.
So it raises just more uncertainty around a time frame for tariffs that this market is already largely discounted. And I think it highlights how people have been saying this is a negotiation with these two trading partners and that would be catastrophic to certain industries. Read Detroit, Michigan, and the auto industry. If they were to go through, the fact that President Trump single-handedly shifted it back a month just sort of doubled down on that. And you can see the Mexican peso really doing really well this year because people are retracing some of their expectations.
I'm going to do something really dangerous and try and read the tea leaves of what happened yesterday.
This is fun.
I might regret this. This is set to take place next week. 25% tariffs on Canada and Mexico. If you were really, really serious about putting 25% tariffs on Canada and Mexico, wouldn't you know the difference between the dates of early March and early April, and how one thing is early April and another thing is early March? Now, maybe you can just say, look, it's been really busy, there was a sense of confusion, and we can clarify things over the next few days. But I would have thought if this administration was really, really serious about putting 25% tariffs on Mexico and Canada, they'd all be on the same page about when that's going to happen.
Wow, you really went out on a limb. I think everyone agrees with you 100% in markets and beyond, and that's the reason why you're seeing the response that you are. It goes back to what are they trying to accomplish? Is this a negotiating tool? What are the deliverables going to be that you can announce from said meetings that are ramping up to the March 4th deadline versus, ultimately, is this a renegotiation of the trading partnership between Mexico and Canada? Again, why Canada? Why are we going after them? What do we really want from them?
You say it's consensus, and maybe it is, but I think the consensus is dangerous on this issue because I find them incredibly unpredictable. I think it could still be the case that they go forward with these tariffs next week.
But this is the reason why it's important to understand what it is they want. Do they want a mea culpa? Do they want some sort of kiss the ring? Do they want something that's, superficial? And then is the political will in Canada right now not there to really deliver that because there's so much anger toward the neighbor treating you that way? So it raises these questions that are unpredictable, sort of like the rare earth deal with Ukraine and what we saw there. And that it seems like it was really a comportment thing and the way that the relationship was between Volodymyr Zelensky and Donald Trump.
The British Prime Minister will get an audience with the President a little bit later. The UK Prime Minister Keir Starmer arriving in Washington ahead of his first meeting with President Donald Trump today. Starmer expected to push for a deal where the United States would reinforce a truce between Russia and Ukraine with some security guarantees. And Starmer's doing the right thing, right? He's doing what the president ultimately wants to see, which is offer to push up defence spending and at the same time pull back on aid spending.
Which is giving him a win. Again, it goes back to that. How can he deliver that? Yesterday, he mentioned in the press conference about jobs that were being brought back from Apple, and we've already talked about that. I mean, he wants the wins. I will just say, Prime Minister Keir Starmer is going a step further, and he's being very smart about how he's framing this to Donald Trump by saying the U.S. needs Europe to succeed for its plans to be successful. And that is the reason why they need to be invested in the success of Ukraine. Again, this is for you. It's not for us. This is really, our strength is really a benefit for your greatness.
Annmarie is in the nation's capital this morning. She'll bring you some coverage of that story a little bit later. The main event, the earnings story of the last 24 hours, NVIDIA reporting some mixed results in its earnings release. The fourth quarter sales topping estimates by the smallest margin in some 2 years. The company warning that gross margins would be tighter than expected as it rushes to roll out its new Blackwell chip. That stock is up by 0.6%. Joseph Moore of Morgan Stanley raising his price target on the stock to 162, citing momentum in the large cap AI space. Joseph joins us now for more. Joseph, welcome to the programme, sir. Appreciate you getting on for us this morning. I'm sure it's been a very busy 12 hours for you. What did you like in the earnings report that gives you confidence that we can achieve that price target?
Yeah, I think, you have to look at this quarter through the lens of a product transition. 2/3 of the data center revenue roughly came from Hopper, a product which is clearly, behind what Blackwell is. And so I think you had customers transitioning from Hopper to Blackwell. There have been some well-discussed supply issues with Blackwell, with the various complexities of the systems level solutions that they have. And you grew the data center business 18% sequentially with that backdrop. And everything they said about Blackwell demand into the back half was what you wanted to hear. So, the gross margins were not as good as we had hoped. And I think that story is going to take time to play out. But I feel like we're past the worst of all of that. And I think looking forward, we have a very strong second half ramp of Blackwell. We continue to be in a very robust AI spending cycle. It's not a bubble. And I think that, this was actually a very good result in the context of transitioning to a new product, struggling with some of the productization of the new product, all that stuff we knew coming in. And I think they've done a good job with that. And I think from here, everything gets better.
Joseph, what do you do when a stock doesn't respond to what you call a very good result, when it's only up by 0.7%? Is there any information that you can take away from that story?
Sure. Well, I think that, to your point, it is a very good result looking forward, but there were some issues around it, right? I think some of that, the gross margin pressure was a little bit unexpected. So I think that's a bit of an overhang. And we had highlighted coming into the quarter, for really the third straight quarter, we sort of have a situation where in mid-quarter, people have worried about a lot of the NVIDIA issues. We've seen people, cutting numbers with a month to go in the quarter. And then going into the results, the previews were much stronger. I thought some of the previews were a little bit high. So I think there's some expectations issues in the near term. So obviously the gross margin issues, there continues to be an overhang of what the government export controls may look like. So all of that stuff is holding the stock back. But we're now heading into a very strong product cycle, and you have the backdrop of every hyperscaler saying how much they're investing in AI. I think that you could foresee some of this. I think, and certainly I think if things stay strong through the end of the year and that visibility remains strong from there, I think the stock can get to new highs.
Joseph, I want to sit on the idea of margin compression a little bit to understand the why behind it. It seemed like there were two features. One of them was the cost of the new data center equipment really was significantly higher than in the past. So this means that as they develop more advanced technology, it's going to cost more. And then they also have to pay their people more because they're trying to attract the top talent. How many of these issues potentially are longer lasting and more permanently crimp their margins at a time where some of the big tech companies that have been their customers are kind of under pressure to pull back a little bit?
Yeah, I think I view most of it as temporary. I think when you talk about gross margins getting back into the mid 70s in the latter part of the year, that's a healthy number. And we've been in the high 70s before, but to me, that's always been a little bit frothy. I think mid 70s is the place to land. I think what we can see here is the complexity of Blackwell has been significant. And what they're attempting to do, particularly moving people to rack scale solutions, where there's multiple issues that you incur above and beyond the chip. I think that's the primary issue. And I agree with you. I think it's the cost of expediting. It's not yield. I mean, they had more Blackwell than we anticipated, kind of understanding what the production is. So there's no issues with the manufacturing of Blackwell at this point, but I think it's productization that's costing them money, feels a little bit temporary. And I think going forward, you may see the company be just a little less ambitious in some of the roadmap issues, because we're so far ahead of the competition here that you don't really need to push the envelope on manufacturability. And so I think when you see Blackwell Ultra, which is a product that they'll start talking about at GTC in March, I think there's much more focus on, let's make sure that we're staying ahead of our competition. Let's make sure that we're ambitious in terms of what we're doing at the systems level, but let's also make sure that we don't have some of these snafus in terms of deliverability. And I think we're gonna see all of that. And so, the equipment is very expensive. There's no question, but I think we just heard a resounding commentary across the ecosystem that people are willing to make these investments. So, I think that the gross margins, it's going to take a little longer to get back to that mid 70s than we thought, but I still think we're going to get there.
Joseph, how much was this earnings season for NVIDIA designed for an audience of one, where the discussion so much in the report was talking about some of the U.S. companies and how wonderful they are and the idea of U.S. dominance, and it was entirely discussing American technological prowess and not really addressing anywhere else, in particular China. How much was that an attempt to pivot toward something that was more palatable for President Trump?
Well, I think this is a major factor, right? I think the AI diffusion rules that were put into place in early January by Biden, are not taken off the ledger yet. So that was a 120-day implementation. So those rules go into effect on May 15th. But we heard a number of things from the Trump administration about different rules, new rules. So I don't think we know exactly what's going to happen. So I think what you are hearing is some attempt to make sure that we can continue to ship in these other regions. They did say some things that were calming. They talked about China being at roughly half of the level that we were at before the export controls kicked in. That's a lower number than I anticipated. But the vulnerability here is not just China. There are, under those AI diffusion rules, there is sort of concept of mid-tier countries which will need to apply for a license to build over a certain scale. And the presumption is they'll get those licenses outside of China. But is that a delay? Is that something that will slow things down? And so I think NVIDIA is very much focused on that and would like to make sure that at least, they certainly are going to be very careful about doing what the U.S. wants them to do, but making sure that we don't get to licensing practices that slow things down, where the presumption is everybody's going to get what they need and we just can't get it as quickly. They're moving incredibly fast to ramp this supply chain, and they want to make sure that they can get product in the hands of customers who need it, under the restrictions that the government's trying to impose.
Joseph, enjoyed reading the note this morning. Thanks for making time for us. Joseph Moore there of Morgan Stanley, the latest there on NVIDIA. Big scare over the last month for this whole ecosystem was DeepSeek. Would it lead to less spending from some of the biggest clients of the likes of NVIDIA? We've had a confirmation over the past few weeks in earnings season that maybe it won't.
Well, maybe it won't. Some people are saying they're going to double down now, but there are still questions about what happens later. And overnight, there was a story about Google laying off more than 100 people in their cloud computing unit at a time where there's more of a focus on inferencing rather than training, which is a lot less intensive of some of these chips.
I wonder also, Lisa, whether it leaves some scouring for valuations for the whole ecosystem as well. Maybe there's a limit on a multiple that people are willing to pay now after being spooked over the past few weeks.
We've seen that with Microsoft and Alphabet. Their shares have not recovered. They're still down, and you just have to wonder if that's the why behind why these shares didn't rally more on numbers that by any measure were pretty terrific.
Nvidia in the pre-market up by 0.8%. Equity futures doing okay this morning, largely positive across the board. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Another big drop-off in yet another sentiment reading. The latest American Association of Individual Investors survey out this morning showed a collapse in those who are positive on the U.S. equity market. 60% of investors said they were bearish. That's up from 40% last week. It's also the highest reading since spring of 2022, when markets were marred by the start of the Fed's tightening cycle and Russia's invasion of Ukraine. Meanwhile, Salesforce shares, they are lower by nearly 4% in the pre-market trade. The company's full-year revenue outlook fell short of analyst estimates. The results dimmed optimism that Salesforce's new AI product would spur faster sales growth. Salesforce launched its AI customer service product, Agentforce, in October. The Agnelli family sold over $3 billion worth of Ferrari stake. Exor NV, the family's investment vehicle, still retains 30% of the luxury car maker's voting rights. The sale proceeds will be used for a, quote, sizable new acquisition and a more than $1 billion share buyback. Ferrari said it plans to buy as much as 10% of the shares disposed by Exor. And that's your brief, John.
Danny, thank you. Why are you shaking your head?
How much do you have to pay to get Ferrari as the last story? And then you could talk about, let me tell you how beautiful their uniforms are.
No, that's not what I was going to say.
And NASCAR is nothing.
That's not what I was going to say.
And
Lewis Hamilton, top of the timesheet in testing, just in case you're interested.
Thanks.
Up next on the programme, the Doge purge continues.
Those million people that haven't responded, though, they are on the bubble. You know, I wouldn't say that we're thrilled about it. Right now, we're trying to find out who those people are that haven't responded.
A conversation up next with Torsten Slok of Apollo as we look ahead to data at 8:30 Eastern Time. Jobless claims just around the corner. Equity futures on the S&P 500 positive here by 0.6%. In the bond market, yields are higher by 4 or 5 basis points. The 10-year 4.30.20. Under surveillance this morning, the Doge purge continues.
I think that email perhaps was misinterpreted as a performance review, but actually it was a pulse check review.
Those million people that haven't responded, though, Elon, they are on the bubble. You know, I wouldn't say that we're thrilled about it. Now, maybe they don't exist. Maybe we're paying people that don't exist. Right now, we're trying to find out who those people are that haven't responded.
So here's the latest this morning. Investors eyeing impacts of Doge's federal layoffs in this week's jobless claims report, due at 8:30 Eastern Time. Torsten Slok of Apollo writing, the consensus expects total Doge-related job cuts to be 300,000. However, studies show that for every federal employee, there are 2 contractors. As a result, layoffs could potentially be closer to 1 million. Torsten joins us now for more. Torsten, good morning.
Good morning.
Haven't seen austerity for a while in this country. Are we about to see it?
Well, I think there are 2 important dimensions for markets of this. First of all, if the consensus estimates are right, and there are various numbers out there, but if we do see layoffs of around 300,000, that raises the first question, namely, is that a big number or a small number? Total employment in the US is about 160 million. So in that context, 300,000 is not a lot. Total number of unemployed is about 7 million. In that context, 300,000 is not really a lot. And the total number of people who change jobs every month is about 5 million. So in that context, it's not really a lot. But if we do take into account that suddenly also contracts are now being canceled, and for every federal employee, there are 2 contractors, maybe then we could have another 600,000 that also could be impacted. So first, which is a number at 8:30, it becomes important to think about what would the implications be if we do see numbers in the 500,000 to a million in terms of layoffs. The second thing is also that if we now start thinking about, well, if there are in total about 3 million federal workers, and there are, again, 2 contractors, that's 6 million contractors, that brings you to 9 million people, and therefore potentially 9 million families that are now being impacted by potentially having the risk of layoffs. So that's why the numbers we got earlier this week for consumer confidence could potentially be a reflection that a lot of people are now being impacted by the risk of potentially seeing layoffs, and that may be why consumer confidence took such a significant hit earlier this week.
You know the longer-term hope. The hope is that as the federal government steps out, the private sector will step in, and we increase the dynamism of the American economy over time. That's the destination. How painful is this journey going to be?
Well, so that's why any adjustment in any economy, when you take people out of one sector, government, transportation, healthcare, whatever sector it is you want to change as a politician, if you take them out and you want to reallocate them to another sector, absolutely, it does involve periods of unemployment. It potentially also involves people who do not have the skills to go into the other sectors that you want to bring them into. So yes, any adjustment in any economy would be involving some pain, in this case, in the form of a higher unemployment rate.
I'm going to ask you a question that you asked this morning. Sentiment bad, hard data good. How long can it continue? So
the answer to that, of course, is that the incoming data, as you talk about, of course, all the time at the moment, is really strong. The number of people flying on airplanes is strong. The number of people going to Broadway shows is strong. Spending on credit cards is strong. CapEx outlook by corporates is also strong. But how long time can we have this uncertainty about both consumer confidence being weak and also policy uncertainty being so elevated and potentially for a more extended period? And the answer to that is that at some point you begin to worry about that it will impact hiring decisions. They will impact spending decisions by companies. So the answer to your question, Lisa, is at 8:30 and potentially also already as soon as next week when we get the employment report, we will begin to figure out, is this uncertainty just talk and uncertainty, or is it something that actually will begin to impact spending decisions by businesses and by households?
And this really is the key question heading into the remainder of the year. You were really strong about the idea that inflation wasn't coming down as quickly as people expected last year. And you were saying that essentially you didn't see the need for all of the cuts that we saw last year that led to the 10-year yield rising. Is that the same thing here amid all of this uncertainty, or do you think that the rally that we're seeing in bonds reflects a great weakness that could be longer lasting?
It is still the case, because if you really think about what's going on, we are turning towards a world with more segmentation. This is not only the US, we had the German elections on Sunday, and segmentation means that countries are essentially saying we are no longer interested in importing as many goods, and if we do import them, they have to be more expensive. That's inflationary. Also, generally speaking, there's also a drive towards saying we're not interested in immigration. That means that that's also inflationary, in particular for wages. And industrial policies in different countries are also now different. Different countries have different interests. That also basically means less competition, which also means more inflation. So on a number of different fronts, you can both have at the same time higher inflation and weaker growth, which is a definition of stagflation. It's a stagflationary shock when you see inflation going up and growth slowing down. And that just happens to be the backdrop for the conversation that we're having in markets at the moment.
Is the Fed cutting or hiking into that?
Well, of course, the Fed now has the choice in the dual mandate to figure out how much weight do we want to put on the slowing growth and how much weight do we want to put on inflation sticking higher. So far, more recently, they have certainly been more worried about the inflation side of the dual mandate. But if growth does slow more meaningfully, if the unemployment rate potentially already hit 8:30 today, and definitely Friday next week, and the following months begins to go up, I do think the Fed will begin to put more weight on the growth risks with the argument that that potentially will eventually drag inflation down. But it's a very difficult spot for having stagflation as the input into the Fed decision making.
Sounds like you're making a bit of a change, though, a bit of a turn.
Absolutely, because we're getting worried about the challenges coming from initiatives, not only in the US, but globally, in terms of what's coming from politicians, in terms of the restrictions on immigration, what's happening with tariffs, and also industrial policies that, generally speaking, again, are things that are inflationary.
Do you think tax cuts by the end of the year can change that conversation?
So I'll come back by the end of the year and we'll have that discussion at that time. But I think that what's, of course, most important now is that the initial policies that have come out on the table are inflationary, namely tariffs moving higher and also potentially something being done across the board towards different countries. And the more that we have the risk that we will both have higher prices and less sales, the more markets should be preparing themselves for the risk that a stagflationary scenario might be playing out.
Torsten Slok of Apollo. Torsten, lots to think about. Appreciate it, sir. Thank you. Bit of a turn from Torsten and the team.
Last year, it was about how much dynamism there was still in the U.S. economy. This year, the global discussion about how tariffs and deglobalization can increase costs, a really interesting one.
We'll build on those conversations in the next hour of Bloomberg Surveillance. We'll catch up with Woodard of Bank of America, the former Trump trade official, Katie Kalutkiewicz. We'll also speak to Waldemar Szlezak of KKR and James Fishback of Azoria from New York City. You're watching Bloomberg TV.
There's a slowdown on the business side happening right now. The consumer is starting to run out of gas.
The economy is becoming a little bit weaker on the short term.
Inflation is still a big concern, but it's being replaced by all this political agenda.
Consumers are looking at these tariffs and they're thinking about the potential inflationary impact.
It's still, to me, too unclear whether these policies turn out to work out great for the U.S. economy or they're actually detrimental.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, so let's start with the scores. On the S&P 500, bouncing back, up by 0.7%, up by 0.75% on the Nasdaq 100, encouraged by this in the pre-market. Nvidia, a little bit firmer, off some half-decent numbers. If you speak to the analyst community, they will say, yes, they were underwhelming, but overall, these are very good figures. The question we've got to answer is, okay, if that's the case, why aren't we seeing a bigger move on a stock?
There still is an overhang of uncertainty about what the future looks like at a time of rapid technological change, at a time where potentially companies are going to get more efficient and buy fewer chips because, A, a lot of their customers are saying, hey, where is the proof that this actually is going to increase revenues? And B, it seems like the chips are already becoming obsolete by the time they come out.
That's the tech story. That's the earnings front. Let's talk about the data. Talked about this a few times already this morning. If you're just joining us, data point of the morning, 8:30 Eastern Time, jobless claims. Why? The cuts to federal workers down in Washington. Are we already going to see that filter out to contractors and start to see that creep into headline figures? Torsten Slok of Apollo with us just moments ago, making a case for exactly that.
Saying it's about 300,000, but there are 2 contractors for every single federal employee that gets cut, so that ends up being about 1 million jobs, and then the families that get affected. I'm just wondering how the market treats that. If you can dissect that it is a DOGE-related increase in some of the jobless claims, does the market infer weakness from that? Do they ignore it? I mean, how is that read-through? I think the market response to that will be as interesting, if not more, than the actual numbers themselves.
We said a few weeks ago on this program, this is the most fascinating moment in financial markets I think we've had since the pandemic, because there are so many different things going on across so many different dimensions. We've talked a lot about trade, talked a lot about cuts down in Washington, D.C. and what it might mean for the data. Also need to talk about the potential of wars ending, crude and energy prices coming lower as a consequence of that. We can talk about that. Also need to talk about the fact that they are planning to cut taxes at some point later this year. How far they're willing to go with that, I don't know. But at the moment, as we know, markets are very focused on the sequencing of things. So they're focused on the things that we're talking about up front. So that's DOGE and that's tariffs. Where we are 12 months from now, this is what we talked to Steve Author Federated about just yesterday. Where is the policy puck going to be 12 months out, and should we skate towards that? What do things look like a year from now?
As Peter Scheer was saying, there's a really good outcome economically and from a market's perspective, and there's a really bad outcome from a market's and economic perspective. And which you choose to focus on becomes something of a personal preference, because at this point, you could see policies to emphasize either point of view. As you say, it might be a sequencing thing, and we end up with tariffs. We might not end up with tariffs. It might be a negotiation to lead us to a better end. Or it might be the confusion that stymies some of the deals that had been expected to go into place and then reduce some of the capital expenditure that was already planned and baked into a lot of valuations.
We're seeing some evidence of that in the early economic data points. It's still only February 27th. I keep reminding everyone, it's week 5. It's week 5.
Almost
it's breathless
week 6.
already. It's week 5.
Almost week 6.
Equity futures right now on the S&P, positive by 0.66%. Coming up over the next 60 minutes, we'll catch up with Jared Woodard of Bank of America as markets react to the mixed outlook for Nvidia. The former Trump White House trade official, Katie Kalutkiewicz, on the latest tariff threat. And look out for this conversation later this hour. James Fishback of Azoria on a possible DOGE dividend. We begin this hour with stocks looking to leave behind a 4-day losing streak after good but not great results from Nvidia. Jared Woodard of Bank of America writing this: artificial intelligence may be the latest in a long line of technologies that raised broad productivity but did not recoup investment quickly, and not by their benefactors. Jared joins us now for more. Jared, welcome to the program, sir. A provocative statement just to start this conversation. Walk me through what you really mean by that.
John, Lisa, I'm glad to be with you. It's a sequencing argument, just like you all were discussing about policy. I think there's a sequencing questioning among investors that's really becoming urgent for the market. When we look at the history of big innovations, big new technologies that transformed economies, think about railroads in the 1800s, fiber optic cable and telecom in the late 90s, even the shale revolution more recently. All of those huge productivity gains came with a big round of initial investment and essentially a bubble in the stock market. a big correction, to put it mildly. And then once the dust had settled, those productivity gains were distributed across the economy, and there were big economic and financial gains for investors. But it was not the first stage investors who reaped the most rewards, certainly not without tremendous volatility. And so investors who are bullish today, who have bullish expectations for years and years to come, we have to ask the question, do you think that this time is different, unlike any other period in history, that there will be a very smooth and seamless transition from initial stage CapEx investment, the rollout of a technology, to immediate and powerful profits that justify those big investments? Our concern is that it's not entirely clear yet that the gains from artificial intelligence are being realized by companies across the economy. That may still happen, but it's the number one piece of evidence that we're looking for to remain bullish on equities over the next year or two.
Jared, can I ask you where you think we are in the so-called sequence?
Well, the initial rollout, it takes time. It takes a long time. And all signs from our analysts at Bank of America and our research department suggests that there's incredibly strong demand across the economy. CapEx expectations are very high. Signals from companies are still quite positive. But it's about the rate of change and about the margins, the profit margins for companies at the heart of this ecosystem, and also revenue from companies who are ultimately the customers for these technologies. And that, I think, is the most important piece to see the next step of progress. That's why we think that the broadening out of earnings later this year among the S&P 493, if you will, is really the most important question to watch. If you can't see earnings broaden out among those other companies, if you can't see evidence that their CapEx investment and the purchases in artificial intelligence are generating real revenue or real efficiencies, then it's a huge problem in the market today, especially given the dominance of passive investing.
Jared, this is a reason why I thought that Salesforce was one of the more interesting earnings yesterday, because they came out with an underwhelming profit outlook for their new agent force, which is basically your secretary that can go out and book things for you that is fueled by artificial intelligence. This was the application that a lot of people were hoping for. Jared, who do you think are going to be the biggest losers, and how much more of a downside do you expect on the heels of the classic boom-bust around technological advance?
Well, that concentration question in the market is extremely urgent in our view, because today passive investment funds account for more than 50, maybe it's 54% of equity market share. That's never happened before in history. And while we have had investment bubbles in the past, you've had the railroads I mentioned, .com, the Nifty 50 period in the late 60s, early 70s, all of those boom-bust cycles where you had big crowding into growth stocks, a turn in the economy or a turn in the market, and then a massive, correction or bear market. All those occurred with a much more healthy and diverse investment ecosystem. Our concern today is that the dominance of passive investing makes investors more fragile. There's more volatility to the upside in this type of market, where market cap weighted funds in every investment account really drive prices higher. Our concern is that it also means more volatility to the downside. So if you do see continued disappointment around the AI theme at the level of companies trying to earn higher revenue or see real efficiency gains, the concentration in the market could accelerate risks to the downside based just on the simple mathematical truth about the weighting of these sectors in the S&P 500 today.
Which raises this question, Jared, about how safe the broadening out trade really is, how isolated people can actually get from a downside to big tech. If this is an index-driven market where people wholesale liquidate their positions, then that could overwhelm any kind of selective buying on the margins. How much do you see the broadening out as sort of a smokescreen argument that you can't really hide if there is some sort of massive correction?
Well, there's a few things you can do. Number one, our colleagues across our department do see some industries and sectors, even at the company level in the aggregate, where earnings growth is becoming much more broad-based. It's a trend we want to see continue, but it's not without some justification, that thesis. I think more importantly, if you're concerned about these risks, two things you can do. Number one is to look at the relative returns of an equal-weighted versus cap-weighted index. That tells you the whole story, in one number. And if equal-weighted stocks keep outperforming the way they have the past couple of days, it's very early yet, but that would be the number one signal to us that there's a bigger shift happening in the market. Number two, investing in high-quality stocks, especially companies with high free cash flow yield, free cash flow margins, has been a massive outperformer across investment cycles. There's a lot of ways to get access to that theme in the market these days, but all of them capture firms that are generating high free cash flow and aren't dependent on sentiment or flavor of the month at the industry level, and are able to weather storms when maybe a traditional cap-weighted index might go through a rough patch. I think it's also worth remembering that a lot of the investments people are focused on today do have filters for profitable companies, and even those indexes adjust, albeit slowly, to changes in the profit cycle and companies that are struggling or not struggling. So it's not a case for us of outright bearishness, but we do think that this year it's important to watch some of those metrics for signs of a turn as companies contend with the revenue upside from the AI investments they've made over the past few years.
Jared, can we finish on flavour of the year? European equities, Chinese tech stocks. Jared, what do you think about geographic, regional diversification? Because certainly we've seen a sentiment shift there over the past few months.
Yeah, I mean, simply put, John, in our year-ahead report this year, we reiterated our bullish view on Japan. That's real, what's happening in Japan. What's happening in China and Europe, I'll just put it down as not yet real. The economic struggles and challenges in China, the lack of technology companies, and struggles with energy and other policies, the debt break in Germany, those are real serious structural constraints on Europe. And until you see massive policy shifts, I think this looks like a trade, not an investment.
Jared, appreciate it. Thanks for your time, sir, as always. The brilliant Jared Woodard there of Bank of America on diversification.
I'm smiling because I'm thinking about if you ran a gelato shop and you had like Europe, really good flavor. You could have its flavor of the month, and I'm curious what, your different flavors would actually look like.
You might feel sick by the end of the year, something like that, right?
You've eaten too much.
Just trying to make that work.
That was really good. That was good.
Just trying to make that work.
Maybe one scoop of Europe and 2 scoops of America.
There you go. Let's get you an update on stories elsewhere this morning. Don't know where that's going. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Trump administration has canceled the meeting. The Food and Drug Administration's Vaccine Advisory Committee that had been tentatively set for March 13th. The committee was planning to discuss how to make the next season's flu shot. The meeting is a routine step to ensure that manufacturers have enough time to produce the proper doses. Elliott Investment Management has ramped up pressure yet again on BP after its new strategy fell short of expectations. Sources tell Bloomberg that the activist investor thinks that the turnaround plan lacks urgency and ambition. BP's strategy reset included selling $20 billion of assets and cutting low-carbon energy investments. Elliott is one of the oil company's largest shareholders. And more ice cream news for you. Ben & Jerry are looking to buy back their namesake ice cream brand. Bloomberg is reporting that the founders have held initial discussions about a potential deal and may look to partner with socially minded investors. Unilever has stated that Ben & Jerry's is not for sale and is instead planning to spin off its ice cream business through a demerger. And that is your brief, John.
Danny, thank you. We made it work eventually. More from Danny in about 30 minutes' time. Up next on the program, tariff confusion.
Mr. President, can you clarify the Canada-Mexico tariffs? You had put that 30-day pause, but you just referred to April.
25%.
25%. When does it go into effect?
April 2nd.
April 2nd for Canada-Mexico.
Correct. And for everything.
We'll try and make sense of all of this. We'll catch up with Annmarie in Washington, D.C. in just a moment. She'll be speaking to the former Trump White House trade official, Katie Kalutkiewicz, from New York City this morning. Good morning. We've just had 6 days of gains in the bond market, 6 days of lower bond yields, a run we haven't seen since last September. Right now, yields are higher by 4 basis points. The 10-year getting back close to 430, 429.81. In the equity market, higher by 0.6%. I'm sure that many of you are very interested in where Nvidia is in the pre-market at the moment, positive by about 2 percentage points. Under surveillance this morning, tariff confusion.
Mr. President, can you clarify the Canada-Mexico tariffs? You had put that 30-day pause, but you just referred to April.
25%.
25%. When does it go into effect?
April 2nd.
April 2nd for Canada-Mexico.
Correct. And for everything. It'll be 25%, generally speaking, and that'll be on cars and all other things. And the European Union is a different case than Canada, different kind of case. They've really taken advantage of us in a different way.
So these are the proposals. Next week, 25% on Canada and Mexico. March 12th, 25% tariffs on steel and aluminum. In early April, reciprocal tariffs as much as 25% on autos, chips and pharma. Maybe April, maybe March. Who knows? Let's catch up with Annmarie down in Washington, D.C. for more. Annmarie, what are the dates?
Well, a lot of people are scratching their heads, Jonathan, because yesterday President Trump was asked directly about the date that is next Tuesday when it comes to that pause on Canada, Mexico, 25%. And he said April 2nd seems to be the date for everything. And then was asked again. He said, correct, April 2nd. But then Commerce Secretary Howard Lutnick then had to explain there is a pause in place when it comes to Canada and Mexico. So lots of dates are flying around. The most important one, though, has to be April 2nd. And then when you talk to White House officials, what they talk about is reciprocity on all these trading partners. But to get a little bit more clarity, someone who used to be in the room driving these negotiations, we're joined by Katie Kalutkiewicz. She was a former USTR negotiator, now the lead for trade at McLarty Associates. Thank you so much for joining us. Lots of headlines yesterday surrounding trade. What did you make of all of it?
Well, I think it's hard enough for businesses to keep it straight, right? And it's indicative that it's also hard for the White House to keep it straight. There are so many memos and orders.
But they're the ones leading the policy.
Well, you would think so. You would think so. You know, it's hard because I think by my count, since the president took over January 20th, 1 month in, we must have 6, 7, 8 different executive orders. Now, some of them are somewhat repetitive. They're asking the agencies to, as you say, figure out who's not treating us fairly and to go after them. But in the mix of all of this, of course, are the tariffs on Mexico and Canada, which you referred to, and which are only deferred until March 4th. The president obviously wasn't talking about those yesterday because he was talking about the broader actions, I think, that he's looking to achieve by April.
Or reading the tea leaves, is there a chance he was in the middle of negotiating those and is just pushing it out to April 2nd that we might not see, which if you look at the peso, they certainly believe that to be, we might not see these 25% on Tuesday?
Well, I think I agree with you. I don't know that we'll see those tariffs on Tuesday, but I think if I'm trying to sort this out as Mexico or Canada or a business impacted by potential tariffs, the tariffs are in place until they're not, and we don't yet have an executive order deferring those tariffs. As of now, they go into effect Tuesday absent any affirmative action by the White House.
Okay, so basically they would have to come out and have another directive.
That's right.
What is telling is that the Mexican economy minister is in Washington, D.C. today, meeting with Jamieson Greer, the new ambassador of USTR. Also on Friday, we'll be meeting with Howard Lutnick. What kind of concessions do you think are happening behind the scenes?
Well, I mean, let's be clear. These discussions are not related to trade. They're not related to reciprocity. They are first and foremost about the border, the president's #1 campaign promise. The Mexicans have obviously brought a lot to the table in terms of border security, in drug cartel cooperation, and the rest. So I think the Mexicans and the Mexican peso, as you point out, are feeling pretty confident that they've brought enough to forestall those tariffs.
What's going on with Canada? It seems to be that this is a punching bag almost for this administration, even though it's one of the biggest trading partners and a staunch ally for decades in the United States.
Well, it's true. I think that for many of us, we're scratching our heads a bit every time Canada is mentioned by the administration. There are some issues, longstanding issues with respect to reciprocal treatment that the president from time to time, I think, gets upset about. But I think the tariffs that were announced on Canada in respect to the fentanyl and border issues were interesting because everything was hit with the 25% tariff except for Canadian energy. And that's indicative that the president understands that tariffs on energy from Canada would dramatically impact our economy. So I do think it's important. It's an important signal that he understands that prices can go up because of these tariffs, and he wants to avoid those. I do think the Canadians are also very actively engaging the White House, and so I suspect they also, with the creation of a fentanyl czar, more support at the border, are also going to seek a deferral and get it.
Okay, so March 4th is in the books unless we get a deferral. March 12th, 25% on all imports of aluminum and steel. Do you think that goes through?
I do. And I think this one is even harder for our allies who are really scratching their heads because, of course, the order on steel and aluminum is really directed at China. But at the present moment, we don't import any steel or aluminum from China, and so therefore we have to hit a global tariff to keep it from coming onto our shores. The president is serious about this. This is something he did in his first term. The Biden administration, of course, supported it, strengthened it. So I think this one is coming.
When it comes to aluminum, steel, also they're talking about as well a memorandum on copper.
Right.
Does the United States have enough of the supply to reach that demand, or are prices going to be going up?
Well, let's remember that Section 232, the underlying executive authority governing these actions, enables the White House to do a series of actions. It can be tariffs. It can be to use things like the Defense Production Act to get production going where we need. These are all intended, of course, though, to address a concern that we don't have enough domestic production. And so it does take some time to get those copper mills going again. And so, depending on the action, you could see prices go up.
One where I think there might be a lot of fireworks, and already we saw that from the rhetoric, is going to be the European Union. What is going on with this potential deal on the table when it comes to the EU dropping their 10% level on tariffs for imports of American cars, potentially to 2.5%, matching the American level?
Yeah, that would be significant.
Do you think that's real? Trump has even said he hears potentially this deal's in play.
I think it is. I think it is real, but I don't think it's enough. Let's be honest. It dropped from 10% to 2.5% on cars to Europe. It's not going to significantly impact the European market, where consumers are not really interested in American cars, and regulations actually continue to create barriers. The Europeans, though, even beyond the car tariff, which we do hear the Commerce Secretary talk about a lot, have a number of regulatory barriers in digital services that the president has, in another memo on Friday, gone on the attack, and a number of other regulatory ideas around the Green Deal and sustainability that I think the president is going to go after.
What do you think Europe is willing to give in? Or do you think this actually goes through on April 2nd? Because it seems like potentially we're in this negotiating mode right now with Brussels.
Well, let's talk about April 2nd. I'm not certain that means new tariffs. The president in his first day asked all agencies to come up with lots of ideas for how to target reciprocity, how to target trade barriers. We could see a series of new investigations, more 232 investigations like the copper one we heard about yesterday, more 301 investigations on things like digital, on shipbuilding is another one we saw over the weekend. So we could actually have a new series of investigations as opposed to tariffs. Now, the president would like to announce tariffs as quickly as possible, but it does take time to calculate the harm.
When it comes to, you mentioned shipbuilding, I think of China immediately. When it comes to steel, you said this is a directive really at China. You were there in Trump 1.0, where we had the phase one trade deal. How much different is it now when it comes to trying to level the playing field with Beijing?
Well, the president has a lot of unfinished business, and I think he's anxious to get to it. All roads do lead to China when it comes to a number of these trade actions. The reality, though, because the United States spent so long trying to confront China through WTO-sanctioned instruments, which frankly was not sufficient in blunting their growth. Now we have some of these very dramatic ideas that impact allies that the president is committed to taking. I do think we always hear about President Trump, the deal maker, and he is. He wants to deal. He wants to negotiate. He has a good relationship with President Xi. I think it's going to get bumpier before it gets better. But I do think there is a real potential here for a phase two, if you will, once we get going.
And amongst all the rhetoric right now, only the 10% on China has stayed. Right. What's your number one piece of advice for clients right now?
Try not to focus on the when. This is what we're talking about. Are they next week? Are they the week after? The tariffs are going to be a threat until they're not. This is 4 years of some uncertainty. So I think we need to buckle up, try to prepare by understanding where your supply chains are, where you can source, how you can move. This is my best advice for preparing. And then one can hope, frankly, that engagement with those up in the midterms will be an important piece of advocacy advice.
Katie, thank you so much for joining us this morning. That's Katie Kalutkiewicz, Jonathan. She was formerly part of Trump 1.0 doing these negotiations. What I took away from the end of that conversation, tariffs, it's part of the feature, not a bug in how they want to conduct policy.
Annmarie in the nation's capital. Annmarie, thank you. More from Annmarie in Washington, D.C. a little bit later this hour. Coming up next on the programme, we'll catch up with Waldemar Szlezak of KKR on the energy and capital demand for AI. The open about 2 hours away. Some economic data about an hour from now. Jobless claims just around the corner at 8:30 Eastern Time. Your scores look like this. Going into all of that at 7:30 here on the East Coast. Equity futures positive by 0.7%. On the Nasdaq 100 positive by 0.8. We are very close to session highs with 2 hours until that cash open. With your morning movers, here's Yahara Hacker. So Yahara.
Hi, John. We start with the check on NVIDIA. Those shares are up 2.3%. And reading through analyst notes, the move here seems to reflect this idea that, yes, NVIDIA put up a solid performance, but not at the magnitude we're used to. But still, the analyst community largely positive. Over at TD Cowen, they're saying, against persistent worries, NVIDIA continues to make the extraordinary seem ordinary, so some perspective there. Next up, we have shares of Snowflake. Those are soaring nearly 12%. Shares are rising after the software maker posted a solid beat, plus the outlook also looking good. They see cloud service growth rising, signaling there's a lot of demand from companies using their AI-powered services in order to organize all their data. And last up, we have Moderna shares. Those are falling 5% now because of our story here that U.S. health officials are reevaluating a $590 million contract they gave it to develop bird flu shots at a time when we're, of course, dealing with an outbreak. But it also adds to worries about Moderna itself because we know this company has been under pressure to find new sources of revenue outside its COVID vaccine. John?
Yahara, thank you. Appreciate that. That stock lower by about 5% in the pre-market. On our radar this morning, President Donald Trump's latest comments sowing some confusion around tariffs. The White House official saying his bid for a 25% tariff on the EU is new, but no decisions have been made. The deadline for Canada and Mexico remains next week.
So if you wanted this market to take these tariff threats seriously, this was not the way to do it. And I think people are probably dismissing the likelihood that these tariffs are going on March 4th, if at all. Question, and I keep going back to it, what does he want in terms of the negotiations from Mexico and Canada? Because ultimately those deliverables will be the tea leaves to understand, okay, coast is clear versus kick to May 4th.
We've said it a few times. It just feels like Europe's different when it comes to these negotiations. And I think the president's basically said it himself. When it comes to the EU's different.
He talked about 25%, but is it 25% on everything? Is it just on autos? I mean, again, it goes to the lack of clarity in how you plan your business and how you plan your purchases around an unclear goalpost. And I think that that's the difficulty that a lot of people are having right now.
A few weeks ago, we talked to Mike Wirth of Chevron about his business and the kind of operations they had in Venezuela and whether things might change. Well, things are going to change, apparently. President Donald Trump saying he plans to revoke Chevron's oil license to operate in the country. Trump citing electoral conditions and the country's failure to take back migrants from the United States as quickly as it promised.
So this again goes to the question of what is the ultimate goal? There is a question about whether this is really a version to the Maduro government and some of the issues that happened late last year, or is it because of the migration issues, which is what you're seeing with Mexico as well? And if it's that, are there deliverables, or is this just a blanket type of order? I don't totally understand it, and I'm curious, do you?
I don't have any thoughts on the matter at all. I'm just sitting here waiting to see how policy changes from day to day.
I thought you were just saying in general.
No, on this specific issue.
Yeah.
I talked to Mike about it. It was on the agenda at the time. Let's just put it that way. It was out there. We were waiting for this change. I think at the time it was Secretary Rubio who gave people a decent steer that this is the direction this administration would go in.
And it's hard to know if there's something that someone can do to offset this direction, or if this is just what they want to do. And if it is ideological, if it does have to do with the election that a lot of people said was manipulated and reported incorrectly.
Let's turn from this story to this one. The White House telling federal agencies to submit plans by March 13th for, quote, large-scale reductions in force. The administration also requiring agencies to submit proposals to move offices out of Washington. The DOGE team set to help execute the plans. It's a big push, a huge effort.
Yeah, and it's one that is probably going to come out a little bit in the numbers at some point, maybe today in the jobless claims that we get in about an hour time. A larger question here. The federal government is a very small fraction of the overall workforce. The state and local governments are not. And really, one of the key questions that people are turning their attention to is, at what point does the DOGE effort shift to states and beyond what's going on in the federal government? I also think that what Torsten Slok was saying was really important about contractors, that for every federal employee that gets laid off, there are 2 contractors associated with that. And even if they can find jobs in the private sector, that churn takes a while.
So we're laser focused on the data we get 60 minutes from now. Jobless claims at 8:30 Eastern Time. Heard from Mike McKee just moments ago. Mike says it might be too soon to see some of this show up in the economic data, but I think we're all in wait and see mode, and you can see that in the economic data anyway already.
Yeah, Mike's point saying that federal employees have a different unemployment insurance paradigm than other workers, so it might not show up in these numbers just yet. That said, if there are contractors, if there are people who work in local shops in Washington, D.C. that aren't getting frequented, do you end up starting to see that churn already?
Looking to see if we get any changes in that data in about an hour from now. Let's look at NVIDIA. That stock is up by close to 2.5% in the pre-market after delivering some mixed quarterly results. The chipmaker's shares have dipped this year on concerns that data center operations will slow spending. Waldemar Szlezak of KKR writing, with the world set to generate 1.5 times more digital data than just 2 years ago, the demand for data center capacity is skyrocketing. Waldemar joins us now for more. It's good to see you, sir.
Thanks for having me back.
Are we seeing any changes at all? So we had the big DeepSeek revelation the last time we spoke. We weren't able to talk about that. We can now. What changes for your world?
Not very much. I think fundamentally we believe that, artificial intelligence today, it's not a fad. It's really a shift, tectonic shift in terms of, general purpose technology evolution, similar to electrification or internet. And I think that sort of a trend is likely going to persist for decades and not years. And so there may be fluctuations in any given quarter or a year, but I think the underlying trends are very robust. You saw it a little bit yesterday from NVIDIA's earnings, I think, as a data point. But I think on the ground, from the picks and shovels elements through our KKR lens, both on the data center side and on the power side, we're one of the largest investors, we are not seeing any change.
Let's stick with your KKR lens. If you see a multi-decade trend, are you reconsidering where you want to be in the whole ecosystem? Do you want your footprint everywhere, or are there certain places, energy transmission, real estate, data centers, are there certain places you'd prefer over others?
I think that's a really great question. So yes, at KKR today we have 5 data center companies. We really have a presence in the United States, in Europe, in Asia Pacific, our recent acquisition or expansion into the Middle East. So we have a pretty good lens of all the different markets. I would say that each of the markets exhibits different sort of trends in terms of growth. I would say the S-curve adoption. And so some markets have already maybe maturing a little bit more, and some are still on that hyper-growth trajectory. I think when you go back to actually the computing piece and the power, those two have now actually merged into a single mega theme. We are a large power investor as well. Recently, we announced an acquisition or expansion or investment into a large transmission network in the Midwest with AEP. I think we saw the convergence of those two themes into a single theme. So I do think that there's a little bit of a shift in our strategy in terms of where we want to position our data center capacity, maybe, de-emphasizing some of the large training centers, focusing more on the inference piece, closer to ultimately population centers, which has always been part of our strategy to begin with. We focused on that as the primary basis of our data center investments. And then I think there's a lot of opportunity in terms of power infrastructure investments. We announced a very large partnership with Energy Capital Partners, so bringing the strength of KKR in terms of digital infrastructure, capital formation, infrastructure, technology, relationships, corporate partnerships, and their strength in power generation. So today we have 50 gigawatts of conventional power under our partnership control and about 75 gigawatts of renewable power development. I think in totality between KKR, ECP, and everything that we're doing, we're I think very uniquely positioned to be the ultimate winner in this sort of a race to deploy AI and frankly reshoring and manufacturing in the United States, but globally as well.
There's a lot to unpack there. I want to just start with the de-emphasizing within KKR, maybe of some of the data centers and more to the power generation and more to other parts of the ecosystem. Did you do this before DeepSeek? Did you see this coming, that there was going to be this shift away from training to inferencing, the idea that you could do more with a fewer number of chips and a smaller footprint?
So I think I would say that our strategy with respect to data centers has not really changed. We're big believers in the growth, the fundamental growth. I think if you look at the numbers today, there's probably 50 gigawatts of global data center capacity. That is likely moving towards 200 to 300 gigawatts. It's just the redistribution within the ecosystem, as you alluded to. I think we were cautious initially on the large training data centers. We thought that ultimately data centers that are constructed and deployed close to major urban areas, ultimately where the workloads are being consumed by either enterprises or consumers, have a more intrinsic value. There are higher barriers to entry. I think there's a going concern element to it versus potentially more speculative deployments that are less location sensitive. I think I would say that there's a caveat to that. I think if you look at, in terms of training, what has happened, and the evolution of scaling laws. I think yesterday Jensen alluded to that. You've seen clusters of 20,000 GPUs being deployed for training and pre-training. We have now xAI in Memphis deploying 200,000 GPUs, right? So we are increasing exponentially the size of the data centers. There is talk today of Anthropic and AWS deploying a 400,000 data center cluster. And yesterday there were rumors, or there's speculation that Meta is making a large deployment of $200 million. That's 5 to 6 gigawatts. That's equivalent to New York City, just to give you the scale. So I'm not sure that there is a tremendous shift, but I think in terms of reallocation, we think that most of the computing infrastructure going forward will be deployed in the production inferencing rather than on the training side. So today it's about 65%. I think that ratio would likely flip in the next 4 or 5 years.
You talk about energy investment, and that's going to be necessary, or power necessary regardless of exactly how this gets deployed. It all takes a lot of energy. As you talk about the size of New York City, it takes a lot to power that. Given the fact that these two trends have merged, the idea of the power required for AI with this just need to increase the energy infrastructure, how do you insulate yourself from investing in something that has elevated valuations because of the fad and the fact that everyone seems to be wanting to get into the same bet?
I think it's a really good question, and I think we struggle with some of that. I think one is we already have 5 established data center platforms. So we are very content with our platforms. We led the largest data center take private ever in CyrusOne in 2021-22. And so I think we are happy to deploy capital to support the growth of those platforms. I think we're a little bit more cautious in terms of investing into new data center platforms at elevated valuations. On the power side, I think we are looking at interesting ways to unlock the opportunity. If you look at in the US power sector, that industry effectively flatlined for the last 20 years. Consumption was about 0.7% over the last 20 years. The expectation is that it likely triples over the next 30 years. So we will move from about 4,000 terawatt hours to 8,000 terawatt hours. So we have to build a lot of new generation in the United States. And I think that's a terrific opportunity for investors. The quantum of capital that's needed is likely trillions of dollars. The market cap of utilities in the United States is about $1 trillion. So I think private capital like ours can really be well suited to help support some of their growth, and it could be interestingly structured to help. I think the redevelopment of this mission critical infrastructure. And as I alluded earlier, our deal with AEP is a perfect example of that. $3 billion investment into Michigan, Iowa, and Indiana. Helps in the transmission infrastructure, helps really upgrade that infrastructure, and as well as expansion of that infrastructure. It's a hotbed for reindustrialization as well as data center growth. So we think that more of those deals are likely to come.
Leadership at Alphabet have made the argument they think the bigger risk is underinvesting, not overinvesting. The bigger risk for any investor is ending up in a situation where there is overcapacity and you can't get out. I don't hear any of that from you. Do you not think that's a risk at all, that we end up with a situation where we just have too many investments?
Well, at some point, animal spirits may get ahead of themselves, right? And I think there is definitely. I would say that the scale and the cost of capital for data center deployments is so high that truly speculating on that would be really reckless. I think most of the data centers that we see being built are built to suit with contracts in hand. And today, vacancies are very low. And really, I think one of the biggest bottlenecks is being able to secure power in most of the markets, right? And if I am worried about something in terms of the trajectory of growth in the United States, is really the ability for us to generate enough power and then actually transmit it to the right places. That's the other piece that I alluded to earlier. But I am a little bit worried that some elements of speculation may occur early on, but winter may come at some point. I just don't know when.
You think that's a public market problem?
I think public markets, to some degree, have. There's so few ways to play the AI bet in the public markets. If you look at it, about 16 trillion of value, about 9 trillion of that is really in a handful of stocks. If you go down the ecosystem, data centers are only about 150 billion of that. So I think people have tried to play this synthetically through investments in utilities, and you've seen a tremendous expansion of utility multiples, et cetera. And so, I am not a public market investor. I'm a long-term investor, and the fundamental trends are undeniable. But could there be some overheating in public markets? For sure.
I was just trying to reel you in just a little bit.
No kidding. I mean, you were basically saying, who's a Cisco? Winter could be coming, and, he's thrown you a bone,
There's a lot to think about there. Let's put it that way.
There are a lot of opportunities, and this is what a lot of people have been talking about and analyzing, that in the booms that you have seen in CapEx that are real, whether it's the railroad system, whether it's a whole host of other things, there are a lot of winners, but they don't always look like the ones at the very beginning.
At the end of the day, I sit in my office, you know this, and I go back over all the interviews and I listen to them very carefully. I'll be doing that with this one, no doubt about it. Valdemar, I appreciate your time. Thank you, sir.
Thanks for having me.
Thank you. Waldemar Szlezak there of KKR. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that Nissan is making plans to replace its CEO after disappointing earnings and the collapse of talks with Honda. The carmaker's directors are gauging interest in potential candidates to succeed Makoto Uchida, who's been at the company for 22 years and served as CEO since late 2019. Iran's stockpile of uranium enriched is near the level needed for nuclear weapons. That surged more than 50% in the last 3 months. The IAEA said that Iran is now producing the equivalent of one bomb's worth of material a month, which could quickly be upgraded to levels typically used in nuclear weapons. An Oscar-winning actor, Gene Hackman, was found dead in his home yesterday. The 95-year-old was found along his spouse and dog at their home outside of Santa Fe. Their cause of death is uncertain, but police do not suspect foul play. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. That's a sad story. Danny, thank you very much. More from Danny in about 30 minutes' time. Up next on the programme, Doge dividends.
There's even under consideration a new concept where we give 20% of the Doge savings to American citizens and 20% goes to paying down debt.
So who came up with that new concept? This guy right here. James Fishback, the CEO of Azoria, joins Annmarie in Washington, D.C. next. Equities near session highs, up by 0.7% on the S&P 500. Nvidia near session highs as well. That stock in the pre-market higher by 3 percentage points and change right now. In the bond market, yields lower for 6 consecutive sessions through yesterday's session. It's a bounce this morning, up by 4 basis points. The 10-year 429.43. Under surveillance this morning, Doge dividends.
There's even under consideration a new concept where we give 20% of the Doge savings to American citizens and 20% goes to paying down debt, because the numbers are incredible. So many billions of dollars, billions, hundreds of billions, and we're thinking about giving 20% back to the American citizens.
So here's the latest this morning. President Trump considering an idea to take 20% of savings from the Department of Government Efficiency cost-cutting efforts and return that money back to Americans. Annmarie joins us now in Washington, D.C., alongside the man who came up with that idea. Morning, Annmarie.
Good morning, John. That's right. And that idea is starting to pick up steam. James Fishback joins me. He's the CEO of investment firm Azoria, but he's the architect behind this Doge dividend. And you're having now all these countless meetings on Capitol Hill. You tweeted this white paper. It's 4 pages long. It's very easy to digest. I suggest people go read it on your Twitter. But then Elon Musk tweeted back at you and said, I'll check with the president. And now this idea has legs. So walk us through, what exactly is a Doge dividend?
Well, good morning, Annmarie. It's very simple. Doge is going to save potentially trillions of dollars over the next couple of years. Let's take 20% of that money and send it right back to the hardworking Americans who sent it to D.C. in the first place, the taxpayers. They didn't send it to D.C. to be wasted, to be defrauded or abused. It was their money. We're sending it back as a refund. There are 2 key benefits to this, first of which is restitution. Second of which, as the president noted on Air Force One last week, let's incentivize Americans to be part of this government efficiency process. They can be our eyes and ears on the ground to report waste, fraud, and abuse. Why? Because the more the Doge saves, the bigger the Doge dividend check will be in the end.
When you speak to members of Congress, I know you were at the House yesterday and you're going to go have meetings today with senators. when they talk about extending TCJA or adding on some of other Trump's priorities, like no tax on tips, no tax on Social Security, they say that they're going to offset this with some of the savings at Doge. So where is the dividend now in that priority list? Because that will take away from offsetting some of the deficit savings.
Well, that's right. I mean, that's a big part of this calculus here on Capitol Hill. 80% of the Doge dividend in our proposal goes to narrowing the deficit and paying down the debt, only 20%. So we view it as a priority. Again, 80% goes to that purpose. But I think the bigger thing is the one-dimensional thinking here in D.C. is that things like no tax on tips or no tax on overtime are somehow an automatic hit to revenue. When we incentivize labor force participation by increasing the all-in pay for hardworking folks in hospitality or leisure, that brings folks off the sidelines. Anne-Marie, 7 million working age men in America are not working. When they hear President Trump's bold plan for no tax on tips or no tax on overtime or even a Doge dividend, guess what? They want to rejoin the labor force so they can earn those benefits. And so the biggest tax offset, to tell you the truth, for President Trump is going to be growth. If these changes can incentivize and supercharge the golden age, we're going to see nominal GDP pick up, we're going to see tax receipts pick up, and this thing is going to pay for itself in spades.
One issue that Trump campaigned on, and many would credit winning on, besides immigration, of course, is inflation. If you send out $5,000 checks, wouldn't that be inflationary, which many Republicans have accused of the stimulus checks we saw under the Biden administration of being?
It's a great point. Now, the stimulus checks under the Biden administration were an entirely different deal. For the first point, there was $6 trillion spent on COVID in stimulus. Only 13% of that was stimulus checks. Now, remember, supply and demand matter both. So you had a massive demand shock at the same time where you had a supply pullback with a labor shortage, you had lockdowns, you had supply chain dislocations. This time is very different. We don't have those considerations. And then secondarily, remember, this was taxpayer money not too long ago that was sent to Washington that is being sent back. And so the macroeconomy is different. Now, remember, under COVID, again, massive supply chain dislocations. Look at what's happening under President Trump and Secretary Bessent's leadership. Drill, baby, drill means lower inflation, lower gas prices, lower oil prices. We're seeing inflation come off, not necessarily last month or next month, but that's the bigger picture. The macro backdrop was disastrous for stimulus during President Biden. It's very favorable today. And when we ask folks, how would they spend these Doge dividend checks? What do most folks tell us? They're going to use it to pay down debt. The only debt, it seems like in the mainstream media these days that folks care about, is the national debt. Consumer debt went up by more than 25% under President Biden. Why? They needed to borrow to keep up with inflation, to keep up with bad policy. Americans deserve a Doge dividend to be able to pay off their own debt that President Biden forced them into.
Is this basically an extra tax refund then? Because if it's American taxpayer money that's being put back in their pockets, is that another way of basically saying this is just an extra tax refund?
Yeah, it's a refund because guess what? You sent your money to Washington to be spent in America, not to be spent in Iraq or a transgender opera in Colombia. Clearly, they violated the terms of that agreement, so money is owed back. It's a refund. If I go to Walmart, if you go to Costco, and we don't like the $1.50 hot dog, we are entitled to a refund. And so, yeah, send the money back to hardworking Americans, incentivize them. The bigger point here, and this is not directly captured in numbers, is we are going to restore the trust between taxpayer and her government. 7 out of 10 Americans do not believe that the federal government is using taxpayer dollars wisely. That number is going to go down. Taxpayer trust will go up under this plan, and I'm honored that President Trump supports it.
James, thank you so much for your insight and your time this morning. Jonathan, that's James Fishback. In D.C., he's being known as the Doge Czar now, the Doge Dividend Czar. We'll see if his plan makes it through Congress.
Anne-Marie, down in Washington. Anne-Marie, thank you. Up next on the program, Binky Chadha at Deutsche Bank. We'll catch up with Jewsikow of Guggenheim, Lawrence Saidel-Baker of ITR Economics, and George Bory of Allspring. From New York City, the third hour of Bloomberg Surveillance. Up next.
market's paying up for quality. And so it's back to stock picking, it's back to factor selection.
We are so dependent on these, large index stock flows. If you start seeing outflows from that, it's going to hit those big, Mag 7.
If we don't have earnings moving up in a meaningful way, it's hard to say we're going to have a big upside to the overall market.
We had high expectations for big market and economy impacts, so we're seeing a slower on-ramp for that.
When you look under the hood, there's rotation happening, and that's what's dampening volatility.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening bell. Your score's shaping up as follows. Just close to session highs on the S&P 500, up by 0.6%. Very close to session highs as well on the Nasdaq 100, up by 0.8%. Supported by a rally in Nvidia, doing better in the pre-market now, higher by close to 3 percentage points at the moment. The next stop for this market about 30 minutes from now. Jobless claims in America, a renewed focus on jobless claims over the past few weeks.
And there are two reasons why. On one hand, you're interested in whether there is this ongoing worry about growth in the U.S., which we have gotten from a number of different data points as reflected in bond yields. Then, of course, there's a question of will we see the effects, the ramifications of some of the cuts made to the federal government from the Doge effort. And that, I think, is what really is going to send people parsing into all the details.
And the impact from tariffs, we're already seeing it before the tariffs even come on. We're seeing it in the confidence data. Will that lower confidence translate into weaker hard data further down the road? You picked up on that line from Torsten Slok of Apollo. That's what Torsten's looking for.
And that's what a lot of companies are looking for, too. You see that in some of the guidance, whether it's Walmart or Target or Sweetgreen, other than a burger company came out and did really well. So at a certain point, maybe people are just sick of eating so many greens. But I am curious going forward whether the guidance and the fears is just going to be sandbagging and setting a really low bar, or whether this is going to come to fruition as people do struggle with policy uncertainty.
We've had a mix. I think on the one hand, some genuinely don't know, and we've seen that from Home Depot and Walmart. Some people are confident, GM. But the investors don't buy the confidence. They come out with a decent outlook, investors sell the stock, and they come out and announce a buyback a few weeks later.
Well, with an auto company, it could be to the point that we heard before, negative infinity if you end up with some of these tariffs and you end up with parts that really become much more expensive at a time when there's diminished demand. It really becomes a question of a binary outcome for some of these companies. We have been talking about markets not buying this idea that 25% tariffs are going to go on Canada and Mexico, certainly not on March 4th, maybe on April 2nd. We'll see. At the same time, with that potential downside, what is the upside bet to some of these auto companies?
What did Ken Griffin say in the last few weeks? Damage is done. Already seeing the damage being done, and I think you can make that argument looking at the economic data at the moment, can't you?
Certainly with the confidence data, and it really turns into when does that come into a lack of jobs, a lack of hiring, some potential layoffs, and that, I think, is what Torsten Slok was trying to get at.
We'll get you some confidence in just a moment, some bullishness. We'll do that in just a second. Equity futures on the S&P up by 0.6%. That bullishness coming from Binky Chadha at Deutsche Bank as stocks snap a 4-day losing streak. We'll also catch up with Guggenheim on its sell rating out of Tesla. We'll catch up with that analyst in just a moment, and we'll speak to Lauren Saidel-Baker of ITR Economics reacting to jobless claims at 8:30 Eastern Time alongside GDP as well. We begin this hour with equities pushing higher after Nvidia's mixed earnings report. Binky Chadha of Deutsche Bank still optimistic, looking for the S&P 500 to end the year at 7K. Binky joins us now for more. Binky, good morning.
Good morning.
Give us a reason to be optimistic. Let's start there.
Let's talk a little bit about the confidence issue that we were talking about, sure, and the pullback basically in both measures that we have of consumer confidence. I mean, the points that, I would note is confidence actually not a very good indicator or driver basically of spending, and you only need to look at the last prior 2 years when confidence was low and spending was great. You could argue, and I think it's an open question as to whether the decline in consumer confidence, it does impact at the end of the day some of the spending on big ticket items, but that's sort of still out there is the way I would put it. But there isn't a robust relationship with overall spending, so it might just be more about rotation. But on consumer confidence, I would argue that it does tend to have an impact on presidential job approval ratings. We also saw that over the last 2 years. So it does matter. But I would argue, bigger picture for equities, what matters is the business cycle. And that's, in our view, what's much more important is really CEO confidence. And here, the clock's been ticking rather fast, basically, so we actually don't have good readings on CEO confidence from the typical providers. I mean, they're dated. That's
you
all.
You track earnings calls, though, so what are they saying on the calls?
Exactly, and that's what I was going to get into. So every quarter we write a report about what companies are saying, and the last one is called, and it's a quote from a company, living in a climate, basically, of uncertain optimism. So the optimism still outweighs the uncertainty, but that of course can change. But bigger picture, if you take a look at the S&P 500 since the election, so it's almost 4 months now, we've been in a very, very, very tight range. That's plus minus less than 2% on either side. So very sharp, very furious moves, but really going nowhere. And so I would say the best explanation over the last 4 months of why we are up one day is because we were down yesterday, and why we are down today is because we were up. Yeah, I mean, that's what the price action basically says.
Is this how the client calls go, Binky?
And so,
check out yesterday.
So you look at where we closed yesterday, right at the middle of the range.
Hold on a second. You said that
we can talk a lot about that what's driving every tick, but that's not kind of like normally what we do. We were just kind of doing that because it's such a tight range.
So let's take this a step further. You said that we're in an environment of uncertainty, and that seems to be what you're hearing on a lot of these calls. How long does it have to be where this environment of uncertainty persists and this level of uncertainty about forward-looking policy before you start to question your 7,000 price target on the S&P?
Yeah, so, first I would say we've been in a very, very tight range for almost 4 months, but you just take one step further back and you look at basically the S&P coming out of the October 2022 lows. We're actually in the middle of that channel. So the big picture hasn't changed yet. And that's a very, very, very steep channel is the way that I would put it. That's 23, 24% at an annual rate. Obviously, if we continue to go sideways, at some point we will break the lower end of the channel. And that's sort of, April sometime. So there's still some time. And I think about the uncertainty issue, it's really about the cumulative impact of that uncertainty over time. So far, I would say, limited impacts. But of course, if you continue along like this, you're very vulnerable to negative shocks because, that's where we are. But what I would also say is one of the things that's basically keeping us in the range, I mean, the issues or concerns that the market has that we've been talking about, I would argue is sort of capping the upside. If you think about this market from a demand-supply point of view, this is a market where, in the absence of any new news, the market is going to go up. So you want an optimistic take. There's 3 elements of demand-supply. There's changes in positioning, which is coming down because of the uncertainty, but it's still overweight. You have flows that are basically continued. So if I take a look at the last 5 days in the U.S., lots of market jitters,
hold on
25 billion in inflows. And we just had earnings at 15% year on year, and so that's where the buybacks are coming from. So in the absence of news, this market flows or rolls up is the way I would put it.
What you just said was really interesting, this idea that actually the uncertainty might be dampening the upside that we otherwise would be seeing. Yes. And that this market would be substantially higher if there was more certainty around some of the policy going forward. Are you saying that you reject the idea that the index level cannot go up significantly or to that 7,000 level because of the big tech dominance and the fact that that trade is over? Do you reject that? And you think that those could lead, and the reason why there is pessimism there is also tied to this uncertainty and this lack of conviction?
No, I think this is, it's not even a pullback. We haven't had a 5% pullback since August of last year. We're just flat, right?
But is there something going on in the internals that gets your attention? Do you see a growth scale warming up in any way, shape or form?
There is clearly, so again, this morning we are up. Last couple of days we were down, and so we are
sort
doing intraday
defensive
analysis.
Cyclicals versus defensive the last few weeks.
Bond yields down, equities down, which is what we saw. That's telling you basically that the market is concerned about growth because that's classic reaction to or market response to to growth concerns. If you look at cyclicals versus defensives, it's the same reading. So there is clearly, some concern basically about growth. How big it is and how far it goes, it's an open question. I mean, I think the cycle has been very, very strong and is likely to remain strong. I think big changes in policy are a risk rather than our baseline view.
So market weight or equal weight? Which is your preference?
Equal weight, but that's simply because positioning in mega cap growth and tech is still on the higher side. Growth is slowing just a little bit, not as much as we expected, but positioning is still too high for the kind of growth that we're getting. So it's vulnerable, somewhat vulnerable, I would say.
You're stripping out the muscle of big tech by doing that, and big tech is a place where we have had a pullback on a Mag 7 of as much as 10% from record highs. Does that not get your interest? Is that not interesting to you?
It is definitely interesting and it's definitely important, but it's in line with our thesis, so I don't, quote unquote, worry about it.
That's not a place where you think people should be.
I think it's still a bit early because positioning is high and growth is slowing, and positioning is, in line with sort of mega cap growth in tech continuing where it has, and arguably even accelerating, which we think is very unlikely.
Binky, it's good to see you, as always. Looking for 7K on the S&P 500. Binky Chadha there of Deutsche Bank. We'll talk about one of those Mag 7 names a little bit later this morning. Tesla has had a really tough ride of it. Tesla, and an analyst from Guggenheim, has got a sell on that stock in just a moment. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The White House ordered federal agencies to ready plans by March 13th for large-scale staff reductions, laying the groundwork for President Trump's most significant cuts so far. The plan also requires agencies to submit proposals to move offices out of Washington to cheaper locations. Musk's led DOGE will help execute the plans. Elsewhere, U.S. health officials are reevaluating a $590 million contract for bird flu shots that the Biden administration awarded to Moderna. Sources tell Bloomberg that the review is part of a government push to examine spending on messenger RNA-based vaccines. Moderna's plans for a big final stage late trial of its vaccine may be impacted if funding is withdrawn. YouTube star Mr. Beast spoke to several financial firms and wealthy individuals to raise a few $100 million to expand his business. Sources say that the funding round could value his company at about $5 billion. They say Mr. Beast, whose real name is Jimmy Donaldson, is raising money to fund a holding company for several of his businesses. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, we'll get you some morning calls, a wrap of what the analysts are saying about Nvidia. Plus, we'll catch up with Jewsikow of Guggenheim on his call to sell Tesla. That conversation up next. So the opening bow is about 1 hour and 15 minutes away. Equity futures doing okay going into that, positive by 0.6%. A real struggle to snap a 4-day losing streak on the S&P 500 in yesterday's session. Equities were higher by just 0.01%. In the bond market, yields have been falling every single day for the past week or so. We've had yields lower by something like 25 basis points plus on a 10-year. At the moment, we bounced back by just 3 on a 10-year right now, Lisa, 428.48.
And there have been a number of really good auctions. I'm thinking about what Torsten Slok said, the idea of a recipe for stagflation. And he's out of consensus where a lot of people are expecting the core PCE data that we get tomorrow to show ongoing disinflation. But I'm trying to think, how does this bond market respond to the potential for stagflation if basically higher inflation is met with lower growth? And these are some of the things I'm not sure people are fully grappling with or frankly fully buy. They're not consensus.
Jobless claims and GDP and a lot of other economic data points out in just about 14 minutes time, so look out for that. Let's turn to the morning calls with just one stock in focus, Nvidia. First up, Morgan Stanley raising its price target to 162 after the company's better than expected earnings. The analyst keeping it as a top pick. That stock is up by 2.4%. Your second call from JP Morgan reiterating its overweight rating on the name, citing strong demand for Blackwell. And finally, Truist Securities raising its price target on Nvidia to 205, citing a notable beat in data center revenue. Let's turn to autos and talk about Tesla. Shares plunging nearly 28% since the start of 2025, but a majority of analysts are still bullish on the stock. Jewsikow of Guggenheim is not one of them. He's one of the bears. He has a sell rating and a 175 price target. Ron joins us now for more. Ron, welcome to the program, sir. Let's start with that sell rating. Why the change? Why the sell?
Well, we've maintained a sell for quite a while, just to be clear. But I would say we have been adjusting our price target around with the various changes in FSD in the automotive business. But we have maintained a sell for quite a while. It's been challenging post-election, to be clear, with the stock moves. But we're of the view that the election largely doesn't change the fundamental value of this business, and most of the autonomous regulation that people seem to be excited about for the election really is still decided at the state and local level, and the federal government has very little control. Did you lose me? I've lost the screen.
We're still here, Ron. No, I can still hear you, sir. Carry on, please.
My screen is shut down on
no,
my
all
end.
good.
Okay.
We'll fly blind. Carry on. I'm listening.
No, and I would say the vast majority of autonomous regulations are done at the state and local level. And the idea that the federal government will have a meaningful impact on Tesla's progress and autonomy was always a bit flawed.
So, Ron, the change I was referring to, and forgive me for not being specific, wasn't actually a call. It's the change in the stock. So we saw the run up into year end. And then all of a sudden, at the start of this year, we've started to see the stock roll over quite aggressively, down by 28%. Now, you referenced maybe some of these hopes around autonomous driving. Do you think perhaps some people have figured out that maybe Elon Musk's presence in the government might be hurting the name more than it's helping the name?
It's a really good question. It's certainly come up in our investor conversations. We're not of that view. I think that this stock often is kind of a price drives narrative story, and it was momentum up, and to some degree it's been momentum down of late. I would say, though, if you were going to frame that politics are hurting Tesla's sales, you certainly could do that by looking at where sales have been the weakest, which is the U.S. and Europe, where I think there is more partisanship, and the idea that Elon's politics could be impacting sales would lead you to that conclusion. But demand has been weak, to be clear, for 18 to 24 months here, and they've been cutting price to drive volumes. So I don't want to jump to the political conclusion, but there have been some surveys that have supported that.
Well, Ron, just taking a look at what happened in Europe, you saw actually electric vehicle sales go up more broadly, while Tesla sales in Europe fell by 45% in January. I mean, how can that be construed as something other than maybe sentiment in the region toward Elon Musk?
Yeah, no, it's a good question. Tesla sales have been comping negative in Europe for the last several quarters, but they did accelerate to the downside this quarter. I think there are two factors. So the Model 3 is weak, which is harder to explain, and I think that could lead you to the political conclusion, because the Model 3 is not supply constrained. And Model 3 sales are down about 50% versus the fourth quarter, quarter to date. Model Y sales are supply constrained. You have the refreshed Model Y coming later this quarter, and I think some of the sales weakness on the Model Y is much more about supply than demand. But we'll have a better picture in the next several months. But I do think that Europe demand is clearly weak. The political conclusion is tough to draw at this point in time.
There's also a question, Ron, about who's running Tesla. Is it possible for someone to be running the government or parts of the government or government efforts, also running a couple of other companies and initiatives, and then running a car company? Has that also entered some of the conversations?
I would say less so. It's a very good question, but less so of late, because we kind of went through this with the Twitter, now X, acquisition several years ago, where this became a big part of the narrative. And I think Elon's shown his bandwidth to manage several companies is quite high. But to the extent the stock keeps falling, it's certainly going to enter the narrative more and more, at least. But I'm personally less concerned about Elon's involvement in the government. We're more concerned about valuation, and I think the robotaxi launch has the potential to be a negative catalyst here, because I think that it should lead investors to realize that this is actually further away than some bulls think. Just because of the scale and the scope of the launch, I think it's going to be quite limited on the front end.
Ron, how far away do you think it actually is?
Yeah, I mean, for us to be a meaningful part of the business, it is 2030 and beyond in terms of when this is contributing meaningfully to profit. Tesla will continue to scale it, starting with the Austin launch, but The initial Austin launch is going to, we think, be employee only. They're going to have to use some level of remote operations. And at least our understanding is it's going to use Model 3s and Ys to start, which may be a bit of a disappointment to the market that at least some do expect the Cybercab to be a part of this at launch. And yeah, to the extent this is 2030 and beyond, we think it's captured in our valuation in terms of we have FSD as a whole being $1 trillion business a decade from now, which is I think quite favorable for something that today doesn't contribute meaningfully at all to the company.
Ron, I'll ask you a question that I think we're all trying to answer and have been for a long time. What kind of multiple does this stock actually deserve? How should you value this name? It's certainly not valued like a traditional automaker, and at times certainly doesn't trade on what's happening with auto sales. How should you value this company?
Yeah, it's a great question. To be clear, we've stripped our multiple, that base valuation, several quarters ago, just because it is really challenging because the auto business is struggling as much as it is, and so much of the value now is tied up in, for lack of a better term, the terminal value with the autonomous kind of push and now robotics. So we do take a DCF approach where we value FSD and the autonomous efforts here separately, just because it's really the only way you can get anywhere close to the current price. If you were to value this only as an auto plus energy business, we think that is worth less than $100. But we do give quite a bit of value to some of the future endeavors here.
Ron, very few people have a sell rating on any company, let alone some of the big tech names, in particular Tesla. What kind of blowback have you gotten from having a sell rating, both through a time when the stock was surging and then now, where maybe it's actually looking prescient?
Yeah, it's a good question. In terms of blowback, I wouldn't say I've gotten a tremendous amount. I think most institutional clients appreciate if you have a view and somewhat stick to it. So I think that our view is the facts largely haven't changed here. The automotive business continues to deteriorate, and we do have a tremendous amount of value for FSD in our DCF. So in terms of blowback, I wouldn't say I've gotten a lot. Obviously, I get pushback from clients all the time, but that is a two-sided debate. I'm sure the bulls also get plenty of pushback because the valuation here does look challenging to justify. And I think with sales deteriorating and what we see as a first quarter delivery miss, the near-term setup is challenging unless you're very bullish on the Austin robotaxi launch or the new models, which we think largely are going to be at least somewhat cannibalistic of the Model 3, maybe not the Model Y. But I think it's a tricky catalyst path from here because the stock ran up so much post-election.
It's had such a powerful run over the last few years, for that matter, as well. Ron, appreciate your time this morning, and hopefully we can continue the conversation through the year ahead. Ron Jewsikow there of Guggenheim. Over the last 2 years, we were up by 62% in 2024, and 2023 higher by more than 100%. This stock has had a very powerful run.
At a time when people thought that it was going to be able to be at the forefront of the shift to us all being able to take a car with nobody in it, driving us around.
Still could be.
Well, the problem is that the technology, and this is what Ron's point was, isn't as far along as people think it is. And the fact that we haven't seen it yet means that people can dream high without necessarily seeing what the path ahead is. That, I think, is going to be a really important one. What does it look like? And then how quickly can you roll it out? And how much do people want to adopt it? I mean, in San Francisco, there already is a program with a robotaxi, and people take it.
That's going to be the debate for the next several years. And maybe much longer than that with this name. Equity futures right now in the S&P positive by 0.6%. In just a moment, we'll be talking about the economic data. A double dose of big economic data, jobless claims and GDP. In just a moment, we'll catch up with Lauren Saidel-Baker of ITR Economics and George Bory of Allspring. Both of them here to react. From New York City, this is Bloomberg. 60 minutes away from the opening bell, seconds away from some economic data stateside. Mike McKee's going to break that down in just a moment. Your scores are shaping up as follows. On the S&P, positive by 0.6%, up by 0.75% on the Nasdaq 100. In the bond market, let's check the scores. 2-year, 10-year, 30-year. Your yields looking like this across the curve. On a 2-year at the moment at the front end of the curve, we're higher by a single basis point at about 4%. On a 10-year, up by 2 to 4.28. With that economic data, is Mike McKee. Good morning, Mike.
Good morning, John. Well, the numbers are just beginning to cross, and we do get a big jump in the number of jobless claims up to 242,000. Last week's 219 revised up to 220. On a continuing basis, 1,862,000 from 1,867,000, so not a major change there. Now, the number that everybody wants to see in terms of jobless claims is whether we're having a Doge effect yet. And right now, initial claims for former federal civilian employees were only 614. Now, these are 2 weeks delayed, so this is as of February 15th. So we are not seeing a Doge impact there in terms of federal workers. Could be some contractors laid off, but we don't have the exact numbers. The biggest increases in claims the week before, Kentucky and Tennessee, don't suggest that we're getting a lot of Doge impact as well. So we'll have to look more deeply into that. We also get durable goods orders, and these are January numbers, so these are more relevant than stuff we've been getting recently, up 3.1% after a drop of 1.8% in December. Capital goods orders ex-air, non-defense, up 0.8 after a 0.2 revised number in December. So good news on the business spending side. And then finally, we get GDP, no change. This is the first revision to first quarter GDP, 2.3%. A little bit of a change in personal consumption, rises to 4.2%. Well, it actually comes in at 4.2, which it was. The expectation was it would be revised down a little bit. So all in all, the big number of the morning appears to be initial jobless claims, but we don't have an exact reason why that has jumped. It does not appear to be federal workers who are claiming benefits. And remember, they have their own separate program from the overall unemployment compensation plans.
So, Mike, we'll give you a few minutes to go over the numbers and we'll come back to you. That data point competed with better data elsewhere. So think about that as we take you towards the bond market, where yields are still higher by 2 basis points on a 10-year at 4.28. At the front end of the curve, still up by a single basis point, just north of 4%, close to 4.1% at the front end of the curve. Equity futures, little dip, bounces back, still near session highs, up by 0.6% on the S&P. Caught my eye. Lisa, I'm sure it caught yours, 242 on jobless claims.
At a time when, if Mike is reading the data and telling us, and I believe him, that there isn't a huge federal employee input and you have to probably back out some contractors, that means that there just were more people who lost their jobs in this past week, aside from what we're seeing in Doge. And if that's the case, it does suggest more weakness. 1 week does not make a trend. This blip isn't catastrophic, and that is the reason why it is not overwhelming better than expected data in other places.
A week tomorrow. Payrolls.
Yeah.
It's coming up quickly. I can give you a sneak peek of our survey right now. 155 so far is the median in our survey. We'll build that survey out over the next week or so and we'll bring you some fresh numbers. But 155 is the number at the moment. The previous read, of course, 143.
It's going to be also participation. It's going to be what we see with jobs, how much the wages are going up. There has been a shift of this stagnation in the labor market, and yet it does seem like the leverage has shifted back to the employers at a time where they're saying, get back to the office. We need this from you. We need this from you. We need this from you. And people say, yes, yes, we're going to be there. And that, I think
Jamie Dimon at JP Morgan made that clear, didn't he?
He did. He did.
At a town hall meeting a few weeks back.
He made that very clear. And he's saying, I've been back in the office through the pandemic. Where is everybody? And you're seeing that reflected across the United States.
Joining us now to extend the conversation, Lauren Saidel-Baker of ITR Economics. Lauren, welcome to the programme. Let's just recap the economic data. I'm sure you looked over some of it and heard the commentary from Mike McKee. What do you think?
Overall, no change to the outlook. This is kind of business as usual. No change to the GDP numbers. Growth is still slowing, but staying positive. So I do see these jobless numbers as a little bit of a hindrance. Again, as you just said, 1 week does not make a trend. Even 1 month does not make a trend. But we're getting that continued story of a little bit of directional deterioration in the labor market. But coming from such an incredibly tight starting point, we had this room to lose.
Lauren, we've seen the economic data soften, though. The soft data has got softer. softer. The survey data on the consumer, we saw that in you, Mitch, last Friday, saw it from the conference board earlier this week. How much attention do you pay for those numbers? And typically when you start to see them weaken like that, do you see it bleed into the hard data eventually?
Consumer sentiment data, I pay almost no attention to. What we see right now, especially from the Michigan data, is that it just diverges so much by Republican or Democrat, how I personally feel about my own inflation rate, right? Do I own my home or do I see my rents going up? So consumer sentiment is a notoriously terrible leading indicator. What I'm more focused on is something like CEO sentiment. And all of those surveys are showing more optimism, showing higher growth expectations for this year, showing more demand to be hiring, especially in the second half of this year. So I think for the more reliable leading indicators, that's where we still do see green shoots. It's just going to be muddling through the political noise in the short term on the consumer front.
Just to give some perspective, the 242,000 of the initial jobless claims that were reported was in tandem last seen on December 6th, and then previously seen much higher than that in October. So these numbers have been jumping around, Lauren, to your point. That said, when it comes to policy changes, we were speaking with Torsten Slok of Apollo, and he was noting that for every federal employee, there are 2 contractors that also lose their jobs. Are you expecting a significant footprint in these reports that really stem from some of the DOGE efforts in D.C.?
Significant is the key word there. I don't see that happening, at least yet. There's so much uncertainty, even with the reported numbers of, DOGE's self-reported savings have come under question. So I think the grand economic story is that there are still skills gaps, right? Especially on the manufacturing and the construction front. Maybe some of these other sectors like federal workers, like tech, that's where we do see a little bit more laxness in the labor market. But generally, this is still a tight market. We still see a lot of opportunity from that kind of core or median U.S. consumer. So we'll watch very closely, but we do need some people, at least, at work in the federal government for it to keep on turning.
Lauren, one other thing that Torsten Slok was saying is that all of what we're getting right now, the muddle, is setting up a stagflationary-like environment, and that you could get a slowing in growth at the same time that you get a pop at inflation. And I'm looking at some of the numbers, and I understand that they're backward-looking and that they're revisions, but if you take a look at core PCE prices in the fourth quarter GDP, they were revised upwards, 2.7% from the initially reported 2.5%. I just wonder at what point you start to see inflation concerns bleed into some of the data and then in turn into markets.
I do see inflation concerns. We'll get the new PCE data tomorrow, and that one's going to be very closely watched because, as I keep saying, 1 month does not make a trend, but does 2 months, does 3 months? We've started to see this relatively sustained inflation, a little bit more to the upside of what the market has expected. So I fully expect inflation to be coming back, especially by the second half of this year, but I think that timing might be bleeding a little bit earlier in some of these key categories that are really pressuring our consumer.
Lauren, appreciate your time. Still constructive on a consumer for the moment. Lauren Saidel-Baker there of ITR Economics. Mike McKee breaking down the data moments ago. GDP, jobless claims, durable goods, capital goods. Mike, you've had a few minutes to go over it all. What jumps out?
Well, you're going to hate me for this, John, but I'm going to dismiss the number for jobless claims this week because we did have a holiday last week and the seasonal factors expected a drop of 22,000. We only got a drop of 2,000, so artificially increased there. When you look at a state-by-state breakdown, the number of claims that went up were in Massachusetts, basically, and Rhode Island. Big drops in a state like California. So it doesn't look like this is something that's related to what's going on in Washington. And as we mentioned, only 614 federal workers filed for unemployment last week. The other thing I would note is that in the durable goods numbers, this is a Boeing story, a big increase, 93% in terms of what Boeing orders came in during the month, and that pushed up the overall number. But still, good news on the capital goods numbers that excludes those aircraft, up 0.8, does suggest that businesses haven't pulled back yet, although interestingly, we did see a pullback in orders for finished metal products. In other words, maybe some people were not putting in orders because they're worried about prices going up.
Mike, I'd never hate you, and I think most investors are listening to the same thing. based on what the bond market's doing. Mike McKee, thank you, sir. Bonds are where they were going into the data. Yields are higher by 2 or 3 basis points across the curve.
And what Mike was saying there is that there are seasonal effects that are artificially increasing some of these numbers. And frankly, that's the point when you take a look at the data. It's like, it's not exactly like a straight line, and it's been some knowledge.
I just love the sound effects. Where have they been?
Well, it's like brick out from my childhood.
Perfect. George Bory of Allspring Global Investments, entertained as well. He's alongside us. George, good morning. It's good to see you.
Yeah, good morning, John.
The whole country's in wait-and-see mode, seemingly. We've heard it from CEOs, seen it from consumers. Anyone in a position to make a decision is in wait-and-see mode. What does that mean for the Federal Reserve?
Well, the Federal Reserve is clearly in wait-and-see mode. I mean, I think they led the charge in sort of guiding the market to sort of wait and see. Their data dependency has basically, obliterated forward guidance for the most part, and they are clearly waiting to see what happens. But as we talk about the data, as we talk about sort of where we are currently economically, the economy is still in a pretty good spot. We're talking about some very granular changes on the margin, which is what we're supposed to do, but they are pretty granular and pretty minor at this point. And so there's this sort of whiff, if you will, of stagflation sort of maybe creeping its way into the narrative as confidence in some areas kind of weaken. Some of the data looks maybe a little bit softer. The more important data is certainly on the inflationary side, where this persistence, this stickiness in inflation it's real, it's here, and it's not going anywhere. And so from the Fed's perspective, though, I mean, they look at a labor market that's fully employed and inflation that is sort of fairly contained with maybe some upward pressure, they are very happy to just sit and wait. That makes it tough for bond investors, but I think that's where they're going to be for quite some time.
That explains what's happening at the front end of the curve. Just go further out along the curve for us.
Yeah.
7 weeks now of falling yields. What explains that?
Yeah, I think that there's some technicals. The seasonality within the bond market is favorable, and again, the wait and see mindset is alive and well in the bond market. Sort of look at our own positioning as we've sort of gravitated a little bit more towards a neutral duration position. I think many of our competitors have done the same, and we're sort of waiting to see, is inflation really going to break out, or is it going to subside or remain contained in some way, shape, or form? And so positioning doesn't look overly stretched, and you've seen kind of the range in, say, 10 years really compressed. We're at the bottom end of the range now, but call it 4.25 to 4.75. We had been hovering right around 4.5. That's a pretty tight range, and we've been there for the last few months. I don't think we're going to break out anytime soon. I think we'll be stuck in this range for a little while. But as Lisa, as you mentioned, tomorrow's inflation data, pretty important. And the labor market data will be very important because that's what drives the Fed.
You sound very calm and measured. But we've been seeing not just the data going up and down and swinging pretty violently, but the narrative in the market shifting pretty violently. And maybe it's just us, but people talking about growth concerns over the past couple of weeks, not inflation concerns. Right. You're sticking with the inflation concern. You said that you've moved more neutral in duration. You think that the Fed is stuck in neutral. And is this neutral? I mean, are you thinking that basically the inflation is the bigger risk than some sort of real decline in growth?
For bond investors, yes. So inflation is certainly the biggest concern that we're focused on. The growth data is still looking reasonably healthy. I think on the margin you could start to suggest that there is some softening, but not enough for we think to kind of get super alarmed in terms of heading into a recession or a dramatic slowdown in the near term. I think the market is still waiting to see what comes out of the administration in terms of taxes, in terms of deregulation, and then certainly the ongoing discussion as it relates to tariffs and immigration. So these are big factors. They're enough perhaps to kind of pull in the range just a little bit, but we have an economy that is fully employed. People are spending. Now the distribution of that spending is pretty skewed. The high end is still doing very, very well and still spending a tremendous amount of money. And at the lower end of the economy, people are spending everything they have. and still kind of drawing down where they can on debt. So there's not sort of obvious signs to us that the economy is about ready to roll over, but inflation's real and it's persistent. And so as we sort of see it kind of gnaw its way back into the narrative, if you will, and into the data, that is something we think bond investors have to stay very, very focused on.
Which sounds like a great environment for credit. It sounds like a really good environment for companies to be able to borrow and actually pay it down while also managing some of these risks and giving investors a bit of a cushion, a buffer from inflation. But valuations are really hot.
Yes.
So how do you play that?
Sure. Spreads are tight. We know spreads are tight. And what we like to say, there's elements of a super cycle in the world of corporate credit in particular. And that has a lot to do with what happened, really coming out of the great financial crisis, low interest rates, lots of low-cost debt on balance sheets. That creates tremendous financial flexibility for companies, the ones that have it, and that lasts a long period of time. We are in that long period of time. So credit spreads are tight for a reason, and there are many companies that are on the right side of inflation. Inflation, can be destabilizing when it becomes too volatile or it rises too high. But modest inflation is actually a fairly good operating environment for companies and for any indebted entity as the sort of value of that debt gets sort of inflated away through time. That's good for credit. It's not a great value trade, sort of just 80 basis points for investment grade credit or 300 basis points for high yield. It's just enough to kind of keep you engaged. It's not a lot to get you wildly excited, but it's very appropriate, we think, for this type of environment. So we want that, our central message, the Allspring message to bond investors is yield, yield, yield. Take what the market offers. The market offers a lot of very attractive real yields, whether it's versus treasuries, corporates, asset-backed mortgages. Take that real yield, sort of compound that through time, and just let your portfolio grow. It's working. It's working in real terms. It's not wildly exciting, but it is working, and we want that sort of in our portfolios.
It's certainly calming listening to you, George. It always is. It's good to hear from you. George Bory there of Allspring Global Investments. We're just hearing from the Richmond Fed President, Mr. Barkin. President Barkin talking about a couple of topics. I'll pick up on one, and that's on what's happening with the job situation, saying that we're seeing a lot of uncertainty on the firing side, that the firing of employees on the government side is real. For hiring to rise, businesses need to have confidence. Watching these Fed officials dance around the changes in policy down in Washington, D.C. is quite something.
Well, especially at a time where you then have to translate this into what it means for policy. Some people speculating that some of the uncertainty is going to let the Fed hold rates where they are for longer. That said, you can make an argument with this level of uncertainty that it would encourage them to cut more quickly. So it sort of raises this question, okay, I understand that they're trying to figure out how to interpret this and feed this into their models, but does it make them more prone to to keep rates where they are or to cut?
So just getting a comment from the President of the United States, Lisa, as well on trade. So a post on True Social. This one will take a while, so forgive me. I want to go through it and get you some of the information. Drugs are still pouring into our country from Mexico and Canada at a very high and acceptable level. A large percentage of these drugs, much of them in the form of fentanyl, are made in and supplied by China. More than 100,000 people died last year due to the distribution of these dangerous and highly addictive poisons. Millions of people have died over the last 2 decades. The families of the victims are devastated and in many instances virtually destroyed. We cannot allow this scourge to continue to harm the United States, and therefore, until it stops or it's seriously limited, the proposed tariffs scheduled to go into effect on March 4th in capital letters will indeed go into effect as scheduled. China will likewise be charged an additional 10% tariff on that date. The April 2nd reciprocal tariff date will remain in full force and effect. Thank you for your attention to this matter. Of course, some confusion yesterday about where we actually were when it came to the schedule of events.
This actually clarifies a lot. What this tells me is he's looking for a deliverable that he can deliver early next week on something with respect to fentanyl and immigration with Mexico. If he can deliver that, then we're going to get the April 2nd back rather than the March 4th. It also points to the fact that this is being used as tariffs to put tariffs on China that will stick, and it raises the tensions there. But to me, this clarifies what the deliverables are and what he's looking to get done.
One step further, additional tariffs on China as well. Equity futures just falling away from session highs there. We're still positive by 0.4%, just not as high as we were. In the bond market, yields were higher by 2 or 3 basis points off the back of the economic data. Yields still basically where they were, on the 10-year up by 2 basis points. We'll head down to Washington, D.C. in just a moment and catch up with Annmarie on these comments from the president. Before we get there, let's give an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to recap the data that was out moments ago, initial jobless claims rose more than expected to 242,000. But as Mike McKee pointed out, the increase was led by Massachusetts and Rhode Island, which both have been hit by wintry weather. Meanwhile, GDP growth last quarter was left unchanged, and core PCE inflation was adjusted higher to 2.7% from 2.5%. Secretary of State Marco Rubio laid out a strategy for managing Russia's relationship with China. He says he wants to dilute ties between the nuclear powers. Rubio also warned that closer ties between the two would be a problem if if Moscow became the, quote, permanent junior partner to Beijing. President Donald Trump says that he plans to revoke Chevron's oil license to operate in Venezuela. Trump cited electoral conditions and the country's failure to take back migrants from the U.S. as quickly as it promised. Under the terms of the license, Chevron would have a 6-month wind-down period to exit operations in the country. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll head down to Washington and get you the latest on the trade front from the President of the United States. The opening about 37 minutes away. Equity futures are positive by 0.25% on the S&P 500. On the Nasdaq 100, still positive as well by 0.5. As we count you down to the opening bell, your week ahead in the next couple of days shaping up as follows. At noon, President Donald Trump holding a bilateral meeting with the British Prime Minister Keir Starmer. At 2 p.m, they'll hold a joint press conference. Then after the closing bell, earnings from Dell and HP. On Friday, the main event tomorrow morning, core PCE. And we'll hear from the Ukrainian President Volodymyr Zelensky, who will reportedly be visiting the White House. Our attention right now is very much on trade. The president addressing Mexico and Canada and the tariffs set to go on next week and saying tariffs are scheduled to go into effect on March 4th, and they will indeed go into effect as scheduled. On China, China will likewise be charged an additional 10% tariff on that date. The April 2nd reciprocal tariff date will remain in full force and effect. Let's try and make some sense of all of this. Annmarie in Washington with the latest. Annmarie.
Jonathan, I'm trying to make sense of this as well because, of course, the pause on Canada and Mexico were just that, put on pause, but China went through in early February. That 10% on China went through, and there was just the pause on Canada and Mexico. The president making it very clear in this Truth Social post that they will go into effect on March 4th. Then there's this additional line, which I think is going to cause a little bit of confusion. China will likewise be charged an additional 10% tariff on that date. Now, I think many people are looking at this and they're saying, is Trump talking about the 10% that already went into effect in early February, or is this in addition to that 10%? I am reading this as Trump is opening the door for potentially another negotiation of this 10% with China that is going to come into effect. They have just 5 days, March 4th. That's going to be the key date now, the first one up when it comes to these tariffs.
AMH, appreciate the update. I've got to get to the price action. Equity futures rolling over just a touch, still positive on the day by 0.25%. Not much movement in the bond market, but Lisa, where you see some movement is in foreign exchange. Dollar MEX, a move of about 0.5%. Euro dollar rolling over as well by a similar amount to 104.37.
Any optimism yesterday that what Donald Trump was saying was a signal that they were pushing back tariffs and that they were less real is getting taken back a bit today. I want to just note that foreign exchange has been the place to really highlight all of the trade bets, and that's where you can see the action today.
So if there was some confusion over trade about the dates yesterday, there is no longer any confusion. Tomorrow morning, we'll talk to Cameron Dawson of New Edge Wealth, Steve Major of HSBC, the former World Bank President David Malpass, Andrew Honhorst of Citi. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.